How's everyone doing tonight? Welcome to the Strategy Room. You are here with the banker next door, your host, Dr. Joe Berquist, and it's so great to be back on a Saturday night on this February 28th, 2026, the last day of February. Thank goodness. I'm kind of all done with the snow, as I'm sure many people are done with the snow out there, at least people in the northern part of the United States, right? So I have a jam-packed show for everyone as normal tonight. We're going to be talking about the lowest mortgage interest rates in quite a few years. We're going to be talking about a lot of Epstein fallout. There is a huge lawsuit with Jane Street. Now, a lot of you are probably going, "Who's Jane Street?" So they're kind of a high-frequency trading firm slash kind of like not a hedge fund type of operation, but we will get into that. And the real question there in that lawsuit is, did they cause the crypto winter of 2026? So we're going to get into a whole bunch of information on that. Got some new tariff news. We're going to be talking about, there was a lot of turmoil in the stock market this week. So we're going to be talking a little bit about that. What got everything roiled up? Well, there was this crazy AI report, what some people were calling the doomsday report that came out. Private credit having issues. We got some inflation numbers that weren't so great, again, with the PPI this week. So, and then Jamie Dimon from JP Morgan, he kind of came out with his comments, so that weren't, kind of add a little bit of anxiety, if you will, to the market. But we also had some other big things going on this week. President Donald Trump gave his State of the Union, the first State of the Union for his second term. So he said he had a lot of interesting things to say in there in the State of the Union in terms of what he's looking to do, policies and different things he's looking to implement. So we're going to talk about a few of those things tonight. We'll have some updated tariff news. I have some other economic indicator news. I'm going to go over the actually 6 episodes that I put out this week. So we've got a lot to get to and a lot to get to. Obviously, we're going to talk a lot about the AI conversation, Block cutting 40% of their employees. We're going to get a little bit more in depth in that because we had some really interesting things that developed just yesterday in the afternoon into the evening with Anthropic. And we're going to, Anthropic basically got into this huge spat with the Pentagon, and now OpenAI is basically jumping in there. So we're gonna talk about that and what that means, what the Fed is basically doing around AI, and how this just plays into the overall economy. Now, I will tell everyone, I am not. I don't fully believe this whole the AI is going to destroy the economy. It's going to take everybody's jobs. I don't really buy into that whole thing, and I'll talk about that when we get to that part of the night. I'll get into all that, but let's get going here as we normally do. I want to get into, as we always look at, the U.S. debt clock here, just to give everybody the overview as we start the evening here. So the U.S. national debt about to hit $39 trillion. We're at basically 38,825 billion. So we're getting ever closer to that 39 trillion mark now. And remember, the pace that we're on right now, we basically go up $1 trillion basically about every 100 days. So a little over every 3 months, we hit another $1 trillion. U.S. federal budget deficit still sitting there at 1.7 trillion, with negative 1.7 trillion. Now, interestingly enough, they still have the tariff revenue on here. I was kind of curious as to whether or not they were going to maybe take that down or give a pause on that, given what happened with the Supreme Court last week and a lot of the kind of tariff uncertainty that we've got this week. But even so, they have the tariff revenue sitting there at $375 billion. With revenue per taxpayer of $3,247. The debt to GDP is still hanging in there at 124%. Now, I did a whole conversation last week on, now this is the federal debt. This is not personal debt. This is not consumer debt. So I did a conversation last week on the consumer debt being at about 99% debt to GDP right now, and about how that could really leap up to 120% or 125% of debt to GDP here in the not too distant future. So that's something we're going to keep an eye on. Interest on the national debt is at $990 billion, so almost at $1 trillion. Um, Now, one of the things on here that's goofy with this website, I don't know if anybody out there has any pull with the people over here that run this website, but their credit card numbers are all weirded out. They've got like $48 trillion in credit card debt. That's obviously not correct. They have this kind of like unfunded debt and interest. Yeah, so I don't know. I'd rather like get back to the regular numbers that they kind of had up here that I'd rather like to see. But anyway, so that is where we're sitting there with that. Now we had some interesting things happen with interest rates this week. So I want to just take a look at this real quick. So our 10-year note actually dropped below 4%. That's very interesting. Why did it do that? That's an excellent question. We're going to get to that in just a second here. But I just want to show that basically all of the notes and the T-bills basically came down just a little bit this week. We had the 30-year T-bond drop down to 4.6%. The 10-year T-note, which is obviously the most important one, which we always take a look at, that dropped to below 4%, down to 3.952. 7-year, 3.7, the 5-year at 3.5, 3.5, the 3-year at 3.382, and the 2-year at 3.387. And the 1-year, 6-month, 3-month, 1 month, all hanging out at about 3.6 right now, except the 1 year is at 3.4. But let's take a look at this for a second. So the mortgage rates have just dropped down to a 4-year low. So mortgage rates remain close to 2022 lows. According to Zillow Lender Marketplace, the current 30-year fixed rate is at 5.81%. Fantastic. Just 7 basis points up from last Thursday's multi-year low. The 15-year fixed rate is down 5 basis points to 5.32%, which is its new low in more than 3 years. So we can see here, now these are rates as of today, February 28th. So the 30-year fixed rate is at 5.81%. The 20-year fixed is at 5.76. 15-year fixed is at 5.32. 5/1 ARM is at 5.82%. But again, this is great. This is really good news. This is exactly what we've wanted to see. We wanted to see the rates get back down into the fives. This is really going to help with the affordability issue. The question I have is, will they stay there? And I'm going to get into, because we're going to get into the why as to, why did some of these rates drop down? And that will kind of answer the question as to, can this continue? So we're going to look at that in just a second. Now, here's today's mortgage refinance rate. So the 30-year fixed on a refinance, 5.85. The 15-year fixed is the 5.42. So now, if you're wondering why these rates dropped down, part of it was issues in the market, right? Part of it was what was going on in the market this week, but part of it was also this. The Federal Home Loan Finance Agency, the chief, Bill Pulte, says that Trump deployed $200 billion to slash mortgage rates. The impact was immediate. So Bill Pulte says the administration rejected selling Fannie Mae and Freddie Mac and instead used the cash to support bond market and ease pressure on home buyers. So the Federal Housing Finance Agency, the FHFA, Director Bill Pulte said President Donald Trump is moving aggressively to drive down borrowing costs, deploying roughly $200 billion from Fannie Mae and Freddie Mac to purchase mortgage bonds. A step he said lowered rates boom right away. Pulte joined Fox News' Maria Bartiromo to say that the administration's actions directly targeted affordability and market confidence. The effort follows a sharp turnaround in mortgage conditions over the past year, with rates now carrying a 5 handle after hovering near 8% previously, according to Pulte. He credited the president's broader inflation fight and direct intervention in the mortgage market for the shift, arguing that lenders have already tightened spreads as risk comes out of the system. They tried to convince President Trump to sell Fannie and Freddie for $100 billion, Pulte says, calling the idea nonsense and noting some estimates value the firms far higher. Instead of a sale, he said Trump used the enterprise's cash to support the bond market and ease pressure on home buyers. In this case, $200 billion reduced mortgage rates boom right away, Pulte said. Pulte also pointed to an additional policy changes, including a push to limit institutional ownership of homes and ongoing coordination with home builders to increase supply. He said the administration's focus is restoring affordability on both the supply and demand sides, emphasizing that we need to be a nation of owners and not renters. Whether Fannie and Freddie return to the public markets remains a presidential decision, Pulte added, saying an IPO is more likely than not, but stressing that everything is on the table. So pointing to the $200 billion mortgage bond purchase, Pulte said the decision underscores Trump's willingness to deploy capital quickly to move markets. President Trump just finds money everywhere he goes, and he uses it for the benefit of the American people. That's really interesting. I wish I could find some money everywhere I go. Okay, so Bill Pulte basically said that Trump took $200 billion from Fannie Mae and Freddie Mac profits. Okay, that's what everybody needs to understand here. These are the profits of Fannie Mae and Freddie Mac. He took these profits and he basically put them back into the market. He put them back into buying bonds and probably buying T-bills as well. And that is part of the reason, not the whole reason, but that's part of the reason why you saw these rates come down and why you saw these rates dip below the 10-year T-note, dip below 3.9%, thus helping to ease the mortgage rates on the 30-year mortgage, the 15-year mortgage, and bring those rates down below 6%. So this is what is actually happening here now. I've got a couple. This is good and this is bad. Like it's good in a sense that it's a short-term solution, right? Like it helps to ease the affordability issue just a little bit, maybe enough to kind of start to open up the residential real estate market a little bit, get things going, get things moving a little bit in there. But there are longer term implications here. Now, I have done episodes on the podcast in the past talking about the conservatorship of Fannie and Freddie. I talked about how they ended up in conservatorship after the financial crisis of 07 and 08. They've been stuck there ever since for basically the last 16, 17 years now. They have been stuck in this conservatorship. Now, again, just as a recap, like what does that mean to be in this conservatorship? Well, what it means is that Congress has control over the profits of Fannie Mae and Freddie Mac. Now, these are profits in the form of hundreds of billions of dollars that come into Congress. Now, Congress, again, they don't have to get this approved. This is not a tax. This is money they get without having to tax the American people. Don't have to do anything there. And this is not money that has to be appropriated. Like, in other words, you pass a tax, the money comes in, and then you have to go through appropriations. How is that money going to be appropriated throughout the government to make use and to best help the American people, right? So the story goes. But this is profits that are coming in. And as I have explained many times, that this hundreds of billions of dollars, this is Congress's slush fund. This is the money that they get to use to go run around and they, we're going to use this money for this pet project and that pet project and do this and do that. And this is really at the heart of the matter. This is why the conservatorship of Fannie and Freddie will not end, because the members of Congress do not want it to end, because that's their private slush fund. And they don't want that money to go away. They want to keep control of that money to be able to use it in whatever way they see fit. Now, I got to imagine that there's some of them that are probably hopping mad because President Trump just stepped in and basically said, hey, sorry, guys, I'm taking all the money from your slush fund and I'm going to go use it to, buy a bunch of bonds and T-bills and drive down the interest rates to make mortgages a little bit more affordable for the American people. Okay, like, yeah, that's really good. That's great. Like, we love it. But I have a big problem with this, because I don't want Fannie Mae and Freddie Mac to be in this conservatorship anymore. I do not want this to be Congress's private slush fund. I want this money to go back. I want them to go back to being private companies again, the way that they were originally intended to be. And I've said this many, many times, and now I'm just afraid that they do this now and they're going to keep doing it, and basically we're never going to get to an IPO, because now the president sees this as an easy way to just go grab this money, pump it in there and try to keep the rates artificially lower, or keep them, keep them down artificially. And then of course, one day when that stops, boom, the rates just go right back up instantly. And then Congress takes that money and is continuing to spend it and use it however they see fit. Uh, so again, I mean, I see good and bad in this. Again, it's great. Like I said, it's great that the interest rates came down. That's going to help people. Hopefully, will help the residential real estate market out a little bit. But again, I don't like the potential long-term consequences. And like I said, I want the conservatorship to end on Fannie Mae and Freddie Mac. I want them out of that. I want this money, I want this out of the control of Congress. Like, that's what I want. Um, yeah, that's where we got to go with this. So, all right, let's look at a couple other things here real quick. Now, there was this other article here that said, American home buyers gain the most purchasing power since 2022. So typical mortgage payments are now 8.4% lower than they were a year ago. So okay, fair enough, but let's look at this for a second. So new analysis finds prospective home buyers have seen their purchasing power rise in the last year due to higher incomes and lower mortgage rates. Zillow published a report on Monday that found a median income U.S. household can now comfortably afford a $331,000 home with a 20% down payment. It found that the typical mortgage payment is 8.4% lower than it was a year ago when excluding taxes, insurance, and assuming a 20% down payment. Now, mortgage rates have fallen on average of 6.96% in January 2025 to 6.1% last month, while incomes have ticked higher to give a median income household an extra $30,000 in buying power compared with a year ago due to shifts in mortgage rates and household incomes. A more than $30,000 gain in buying power is meaningful for households that have been stretched thin by high rates, and it can mean the difference between settling and choosing. So again, this is interesting study put out here by what was that, by Zillow. So that's great. But I just, again, it's helping a little bit, but it's still not perfect. We still have a lot of issues out there. I mean, property taxes continue to go up. We still have an issue with homeowners insurance. Surprisingly, homeowners insurance has just gone through the roof in most states. Anybody who's in Florida, if I got any listeners in Florida out there right now, like, please put some comments up there about how you're feeling about homeowners property insurance right now. They're not loving it. So again, I think that the problem is it's not that, if interest rates come down, that's magically going to fix everything. It's not it. We have a problem where all of our costs across the board for owning a home have gone up. Repair costs have gone up. Your utility bills have gone up. Like I just said, your property taxes are going up. Your homeowner's insurance is going up. All of those things together add just a lot of pressure on your typical homeowner. Now, if you've been in your house for a while and you've built up equity and stuff like that, you're probably managing it okay for the most part. But again, if you're a brand new homeowner and you've only owned a house for maybe a year or two, you're probably not loving the ride right now. You're probably going, man, this was not what I signed up for. So, but anyway, all right. But let's look at two other things here real quick. So, Lowe's and Home Depot had their earnings come out this week. So, and I always love looking at Lowe's and Home Depot's earnings, because these are two of the companies that they are bellwethers, right? These two companies, they give you a great insight into what is going on in the overall real estate market. If you watch what's going on there, if Lowe's and Home Depot are doing great, that is usually a pretty good indicator that the contractors are doing well, the real estate market is doing well. So again, these are great. These are not perfect. It's not, they're not meant to be perfect, but there are certain things you look at. Like I always say, it's like fast food. If you want to get an indication as to how the lower class is doing, how the middle class is doing, take a look at fast food restaurants. I guarantee you, if fast food restaurants are doing fantastic, if McDonald's is killing it, if Wendy's is killing it, that's usually a pretty good indicator. But what are you seeing right now? Well, you're not really seeing that. You're seeing Wendy's closing hundreds of stores. You are seeing, I just saw announced today, like Papa John's is going to be closing a ton of stores. So that's what you're seeing out there in kind of the fast food realm. So now what are we seeing here? So Lowe's CEO says the housing market is under pressure, even as the retailer sales jump by more than 10%. So that's pretty good. So Lowe's beat Wall Street expectations for revenue and earnings for the fiscal fourth quarter. For the current fiscal year, the retailer said it expects total sales to range between 92 billion and 94 billion, and adjusted earnings per share to be between 12.25 and 12.75. In an interview with CNBC, CEO Marvin Ellison said the home improvement retailer is still dealing with a housing market that does not have a lot of tailwind. So, okay, fair enough. Now let's take a look at Home Depot. So Home Depot tops earnings estimates for the first time in a year as demand for projects remains muted. So Home Depot sales fell, but it topped Wall Street earnings and revenue expectations for the fiscal fourth quarter. The company is dealing with slow housing turnover and high interest rates that have stalled major home projects. Home Depot CFO Richard McPhail, if I am I saying that right? I hope I'm saying that right. McPhail also said the company is evaluating the 15% across the board tariff President Donald Trump announced after the Supreme Court struck down many of his import duties. So again, so what we are seeing here right now is that Lowe's and Home Depot are doing very good. So their numbers were good. They think things are okay, but they're still seeing projects as being a little muted. And as the Lowe's CEO put it, the housing market that does not have a whole lot of tailwind. So again, not so again, I guess you could put this in the category of not doing too bad, but not doing wonderfully fantastic either. So, but again, I think we all hope that with the lowering of interest rates, that at least begins to kind of thaw the residential real estate market here a little bit. And we are about to go in to the spring selling season, which is usually the big selling time of the year for residential real estate agents. So, fingers crossed, hopefully, if mortgage rates stay down where they're at, we will get some pretty good activity in the spring selling season here. So we'll see. Hopefully so. All right, let's go to the State of the Union for a second here. So President Donald Trump gave his first State of the Union for his second term. Now, he had some very interesting things here. And this article is basically says, 8 takeaways from Trump's State of the Union address. So I don't want to go into all this, but I wanted to focus on a couple things. So new retirement program proposal. And I want to just make this a little bit bigger here for everybody. So hopefully people could see this a little bit better. So Trump's speech focused in part on bettering Americans' financial situation through new policies on retirement accounts and home ownership. Next year, my administration will give these often forgotten Americans, workers, great people, the people that built our country, access to the same type of retirement plan offered to every federal worker, Trump said. His policy will provide 401k plans with up to $1,000 per year and matching contributions for workers whose employees do not provide them with plans. Estimates suggest that about 56 million workers currently have no employer-sponsored retirement plans. The president also touted lower housing costs, mortgage rates, which we talked about. But this is very interesting. Now, that's a lot of people. You have 56 million people, workers there that basically currently have no retirement plan, and for the most part, I would say probably a huge chunk of those people are people that are working for small businesses, probably that have 10 or less employees. Again, a very common thing if you work at a very small company that only has 3, 4, 5, 6 employees. They generally are not big enough that they're offering some kind of a retirement plan to their employees. So it would make sense that you've got 56 million Americans out there right now, especially if they're working for some kind of small business that don't have this retirement plan. Now, this would be huge. But again, it gets back to that notion of like, okay, how are you funding this? Like, where is that money coming from? You're going to give them $1,000 each year in matching contributions, which again, and I'm not saying this isn't. I'm not saying that this isn't good. I mean, these are the kind of things that I think the government should be talking about doing to help people, especially since the fact that we basically do have a retirement crisis in this country that doesn't really get a whole lot of conversation. They talk about, oh, well, the stock market's up and the Dow hit 50,000 and all this kind of stuff. And that's great. And I've done episodes where I talked about how, Fidelity puts out a report and they say, oh, we've minted all these new 401k millionaires this year and everything. And that's great. That's fantastic. That's positive news. But the reality is there are still a huge, huge chunk of Americans out there that do not have, they don't have any kind of retirement plan. There's no 401k. There's nothing out there for there right now. So I think this could be a great thing, Mike, but it also gets back to my one question. How are you funding this and where is this coming from? And, is everybody's tax dollars now going to, fund everybody else's retirement? So that's, I mean, in a sense, it does in a way with Social Security. But this is something different. This is another thing outside of Social Security. So I don't know. Well, like I said, we'll continue this conversation later as we get more details and more comes out on this. So, okay, let's look at this thing. Data center energy deal with big tech. So Trump unveils a deal with big tech firms that will have them shoulder more of electricity costs generated as a result of data centers used for artificial intelligence development. So I keep this one in mind. I've got another article that we're going to talk about when we get into the AI conversation in a little while, a little bit later in the show. When we get into the AI conversation, we're going to come back to this because I have another article because Trump is meeting with all the tech heads, all the big tech guys this week at the White House to basically talk about them signing this deal supposedly to basically have them pay for the electricity demands to fund the AI data center. So, but we'll see. But like I said, we'll get into that a little bit later in the conversation here tonight. Then it gets into media highlights. Yeah, I don't really want to go through that. Other things, guest spotlight, economic agenda. Trump strikes a softer tariff tone, teases income tax replacement. Maybe. Again, we'll talk. When I get to the tariff stuff tonight, we'll a little bit later. We'll talk about that. Now, here was a really interesting one. JD Vance, the vice president, is set to now lead a new fraud task force. So among his new policy promises on Friday night, Trump said he was officially announcing the war on fraud and would appoint Vice President JD Vance to lead the effort. The vice president responded saying, "I'll get it done." The president said that fraud was rife across multiple states and that a task force was required to eliminate it. When it comes to corruption that is plundering, really, it's plundering America, there's been no more stunning example than Minnesota. Now, I have always said, I did an episode on the Minnesota fraud, going back probably 4 weeks ago now. My big dilemma with the Minnesota fraud thing, again, obviously the fraud is horrible. You want to root that out wherever it is. But my focus, being a channel that focuses on banking and finance, my focus was how is that effect going to ultimately, hit banks? And I think that this is going to hit banks in a very big way. I've talked about that over the last few weeks. I do think that this fraud has metastasized across the entire United States. I think you could find levels of this fraud in pretty much about every state. I think every state's got some level of this going on. And, and it will be very interesting to see what becomes of this. Does this fraud task force, do they get things done? Do they have to rely on the DOJ, who doesn't really do very much these days? Do they have to, how does this work? Do they put the emphasis on banks? Do they put the emphasis on banks to figure this out? And I want you to hold that question for a second, because I got something else to follow right behind that here in a minute. Now, this was huge too. Trump backs bill banning congressional stock trading. Yes, absolutely. I have wanted the stock trading. I have wanted this banned for 25 years. I've wanted this banned. And it is absolutely absurd that Congress gets away with this. There are people on both sides of the aisle that trade and on insider information and make ridiculous amounts of money, and they are able to get away with this scot-free. I would go to jail. You would go to jail. All of us would go to jail for doing the kind of stuff that Congress does on a daily basis with trading stocks and making ridiculous, ludicrous amounts of money off of trading insider information. And it is repugnant, it is repulsive, and it needs to stop. If you ever wondered, what's one of the ways that somebody goes into Congress and they're making 150 grand a taxpayer salary, but yet they're in there for 12 years and they come out and they were worth $500,000 net worth when they go in there, and they've got a $50 million net worth when they come out 12 years later. Well, it's because of this. It's because of stock trading. It's because they're trading on insider information. And like I said, it's ridiculous. And they haven't banned this yet because, again, who wants to kill the golden goose? That's the question. Who wants to kill the golden goose? It's almost the same. It's almost a very similar type conversation as what I just talked about with Fannie Mae and Freddie Mac about how that's their slush fund. And again, it gets back to that question: who wants to kill the golden goose? Nobody wants to kill the golden goose. So. All right, so that's the stock ban, which is great. So again, the stock ban, JD Vance on the fraud, the potential new 401k type accounts for small business employees, basically that don't have that offer or don't have the ability to get to that. So so the president really talked about some very interesting things in the State of the Union that could have some long-standing ramifications on a lot of things. So we'll see. Now, getting to the fraud question for just a second. Now, we had this that came out this week also. So Trump administration considers requiring banks to collect citizenship information. So potential executive order would enlist banks in the White House's illegal immigration crackdown. So the Trump administration is weighing a possible executive order or other action that would require banks to collect citizenship information from customers. A new front in the administration's crackdown on immigrants living in the U.S. illegally, according to people familiar with the matter. Now, let me just I'm going to make that a little bit bigger there, so hopefully people can see that a little bit better. The action, which is primarily under review by the Treasury Department, could ultimately task banks with asking for an unprecedented new category of documents, such as passports from both new and existing customers who want to maintain a bank account in the U.S., the people said. Discussions about the potential executive order have alarmed banks, which have lobbied Treasury and questioned the legal basis for the proposal, some of the people said. The administration was still reviewing its options, including the potential for an executive order or Treasury action, the people said. Banks in the U.S. are required to collect certain information under Know Your Customers rules to guard against money laundering and crime. That often includes collecting passports and social security numbers, but those rules don't include gathering citizenship status specifically, and banks don't routinely share that information with the government. There is no prohibition on banks opening accounts for non-citizens in the United States. Yeah, so again, this is one of those things that gets to the heart of a couple things. Like, first of all, like, yes, are banks going to be in favor of this? No, absolutely not. They're not. This is not going to be on their list. Banks have been dealing. I've talked about beneficial ownership information with businesses. They've had to deal with all that, stuff for the last, few years here. They're still trying to push back on trying to get that, basically out of their purview, and now they might get pushed back on this, or now they potentially have this to deal with. So now, the other thing, what are some of the reasons why banks may not want to do this? Well, number one is, again, you're adding a huge hassle. Banks already have a ton of documentation that they have to get on people when they come in to open an account. Like, a lot of times it's like, okay, bring a bill with you that has your address on it, bring your social security card, bring your driver's license, bring other information with you to come into the bank to open an account. So there's already a lot of documentation that has to be gotten in order to open up accounts and everything at banks. Banks have to comply with CIP. KYC, EDD. We love our acronyms in the banking industry. But there's a lot of regulation that banks have to abide by in terms of complying with BSA, the Bank Secrecy Act, and AML, anti-money laundering. And just again, adding more stuff to it is just going to complicate things. And I could see a lot of existing customers, not being too happy. If you got a customer that's been a customer of the bank for 10 years, 20 years, they've got, 5, 6, 7 different accounts with you. And now all of a sudden they come in and they're like, hey, I just need to open up another account for the business, or I need to open up another account for one of my kids or something like that. And it's a custodial account, whatever. And now it says like, oh, well, before you do that, you're going to have to bring in, your passport or your birth certificate or whatever, this, that, and then it's like, wait a minute. It's like, why do I have to do that? I've been a customer of the bank for umpteen years. You know who I am. Like, why do I, I live right down the street. Like, what is this, So it's not going to make customers very happy. On the other hand, I'm going to play devil's advocate here for a minute. I have been of the opinion, and I've not again, because I try not to make this, I really try not to make this show overtly political, but I've been of the opinion that, as far as the illegal immigrant issue, I have always said that if you wanted to get illegal immigrants to go home, all you had to do was cut off the money. You don't have to send ICE all over the place, arresting people, do everything. You don't need to do any of that. All you have to do is stop banks from being able to open accounts. You just have to be able to stop them from being able to get welfare. You cut the money off, and they will leave. They will self-deport. They will go. If there's no money, if there's no freebies, they will go home. Okay, that is just a reality. If they can't get a job, if the money from the government stops flowing in, if all the freebies stop, they're not getting free healthcare, they're not getting all this stuff, they will go home. They will go home. That is just a fact. You don't have to send anybody out to get them. They will basically say, you know what? I can't get a job. I can't make any money. I can't send any money home to my family. I'm going to get kicked out of the bank that I'm in. So it's going to make it very difficult for them to operate in the country. So therefore, they will ex-day. They will leave. Okay, that and I'm not saying that like that's what I want to have happen or that's what they should do. I'm not advocating for any of that. I'm just saying that would be that if you were looking to do it, that would be one way to potentially solve the issue. But so this, again, potential executive order here, again, this could have a lot of different wrinkles for it, could cause issues for banks in both. It could be both good and bad. Could cause a lot of customer service issues, but it may help to crack down on some fraud. Again, dealing with some illegal immigrants and things like that. It could help in those realms. But like I said, there's a lot of pros and cons to this. So we'll see what happens with that. So, but all right, let's move on. Okay, so now I want to cover what happened in the market this week. The market was down. A lot of kind of craziness in the market this week. I'm going to show everybody here about 5 or 6 articles, and so what I'm going to do is I'm going to run through this real quick. I'm going to show everybody this series of articles real quick, just to lay out what were all the issues, and then we're going to come back through this. So, okay, so the first thing that hit was this viral doomsday report lays bare Wall Street's deep anxiety about AI futures. So, Citrini Research's thought experiment rattles investors already wary of tech disruption. So this report comes out early in the week on Monday, and it just spooked the market, right? It just like this basically, AI is going to eat, AI is going to take all the jobs away. It's going to be a nightmare. All this stuff happens. It really spooked the market. The market, market immediately dropped. So it's a crazy thing. But on top of that, we had other things going on here. We had Blue Owl fallout sets off retail investor panic. Their advisors are urging calm. So you had this AI report. You had Blue Owl, which is part of the private credit market. So you had these big time issues in the private credit market. Then you had the inflation numbers. We had core wholesale prices rose 0.8% in January, much more than expected. So not a great PPI inflation index report that came out. Then you had UBS downgrades the US stock market. Here's what has the investment bank worried. Then you had JP Diamond or Jamie Dimon from JP Morgan. My anxiety is high over future credit cycles. So elevated asset prices and an intensely competitive landscape remind the CEO of the years just prior to the 2008 financial crisis, he said on Monday. So these were all the big things that basically happened on Monday and Tuesday that really spooked the market this week. All this stuff together really got the market, just not in a good not in a good place this week. So let's go back to this doomsday report, if you will, here for a minute. So the doomsday report comes out. So the Dow Jones Industrial Average fell 1.7% or 822 points on Monday, driven by fears of AI disruption and new trade policy uncertainty. I forgot about the trade policy uncertainty. That obviously played into that, but not as much as this did. So it doesn't take much to cause tumultuous stock moves in a market top heavy with tech shares and jumpy about the prospects for artificial intelligence. But nothing underlines the sensitivity of stocks right now, quite like what happened on Monday, when one of the factors behind the Dow's 800-point drop was a 7,000-word hypothetical. A viral report by Citrini Research tapped into a new strain of fears about AI, painting a dark portrait of a future in which technological change inspires a race to the bottom in white-collar knowledge work. Concerns of hyperscalers overspending are out. Worries of software industry disruption don't go far enough. The global intelligence crisis is about to hit. The new broader question, what if AI is so bullish for the economy that it is actually bearish? For the entirety of modern economic history, human intelligence has been the scarce input. Citrini wrote in a post it described as a scenario dated June 2028, not a prediction. We are now experiencing the unwind of that premium. Many of Monday's moves roughly aligned with the situation outlined by Citrini, in which fast advancing AI tools allow spending cuts across industries, sparking mass white-collar unemployment and in turn leading to financial contagion. Software firms Datadog, CrowdStrike, and Zscaler each plunged more than 9%. IBM's 13% decline was its worst one-day performance since 2000. American Express, KKR, and Blackstone, all name-checked by Citrini, tumbled. That anxiety, coupled with renewed uncertainty about trade policy from Washington, weighed down major indexes on Monday. So again, very interesting. And then we go into the private credit fallout here. So Blue Owl fallout sets off retail investor panic. Their advisors are urging calm, of course, as they always do. Help us rearrange the deck chairs on the Titanic. Listen to the band play their violins. Don't pay attention to the ship going down. I love it. Private markets. Giant hosts a call to reassure wealth advisors who connect clients to its funds. Now, keep in mind, this is one of the big things about the private credit market, and one of the big concerns has been, they are trying to get retail investors into the private credit market. Now, who typically is in the private credit market, you might ask? Well, that's a great question. So it's typically, hedge funds, banks, private equity. Those are the usual players in there. Now, if you want to get in on the private credit market action, you usually have to be what's called an accredited investor in the eyes of the SEC. And you usually have to go through maybe some type of a brokerage or a investment banker, somebody of that nature, to kind of get you access, or go through a hedge fund or a private equity fund that maybe has that. Now, Blue Owl is a private equity fund that basically has their own private credit funds. Okay, so you could go through them and get invested and stuff like that. Now, my point here being is that the problem with these investments is that, when retail investors panic, they want to sell immediately. The key word there, immediately. They want to sell and they want to get out. The problem with the private credit market is that these are the type of products that you cannot easily get out of these things. And as we will see with Blue Owl, again, if you're a private equity or whatever, what can you do? Well, you can cut off the flow of money going out. You could basically say, yeah, we're not going to redeem anything right now. Sorry, guys, we're not doing it. And then, your only recourse in that action is you can sue them. But obviously, if they're not going to redeem, your withdrawal request at this time, obviously there is a big problem there, and that's a big problem. So all right, so private credit, again, private markets giant hosts a call to reassure wealthy advisors who connect clients to its fund. So Robert Hendricks immediately emailed his wealth advisor after seeing headlines on X saying Blue Owl Capital was halting redemptions in one of its private credit funds. His advisor told him that he was invested in a different Blue Owl fund and that the fears around headlines were overblown. He plans to redeem the roughly $75,000 he has invested anyway. The last thing you want to hear as an investor is that the door is closing, said Hendricks, an Ohio resident who first invested in private credit about 2 years ago. Hendricks is among the individual investors who piled into private credit funds in recent years and are now wondering whether they made a mistake. The latest cause for concern, Blue Owl, a private credit juggernaut, said last week it was selling $1.4 billion in loans to give money back to investors in certain older funds and ending quarterly redemptions for one of them. The firm thought the announcements would be viewed positively. Instead, its shares and those of other private credit lenders slid. So we could see here are the shares in this chart. We have basically all the big players, right? We got Blackstone, we got Apollo Management, Global Management, Blue Owl, we got Ares Management, we got KKR, all the big bad players on Wall Street here, all taking a nosedive. To complete nosedive here from you start out at January and now we're down here. Let's take a look at where's Blackstone's down 26.4%. Blue Owl is down almost 30%. KKR, let's see if we can hit KKR here is down 27%. So, I mean, these things are really taking a beating right now. So now the wealth advisors who connect wealthy clients with such funds are facing one of their first big tests. With growth slowing from traditional pension fund and endowment clients, private market giants such as Blue Owl, Apollo Global Management, and Blackstone have aggressively courted individual investors from everyday millionaires on up. The firms are now pushing to get their offerings into 401ks. As I stated, they're trying to get this investment in the hand of retail investors, which I think is a huge mistake. The funds make loans to companies, often those backed by private equity firms, and aren't as closely regulated as some banks. Some in the investing world have said the funds aren't well suited for the masses. They are not, in part because they tend to come with higher fees and are harder to sell. What did I just say? These investments are much harder to get out of. They're easy to get into. They're not easy to get out of. Many wealth advisors said they haven't lost faith in private credit and are counseling their clients to stay put. They said the fears surrounding Blue Owl aren't tied to evidence of losses or poor underwriting, but rather to misunderstanding. Yeah, wink, wink, wink. So it's all just a big misunderstanding. Don't pay attention to all of those companies that went bankrupt, was it Tricolor Holdings and First Brands, and the fact that the CEO of First Brands just got charged with fraud. Don't pay any attention. Don't pay attention to that. It's like it is literally like that scene. If anybody has seen The Naked Gun, everybody knows that famous scene of Leslie Nielsen standing in front of the fireworks company that is on fire and is just blowing up. And, just telling the whole crowd, nothing to see here, nothing to see here. Everything's fine. Don't worry about it. Go home, disperse. Nothing to see here. It's exactly what we've got going on right here, right now. So, all right. So and here's some other articles on this. So just real quick here. So Blue Owl Capital CEO disputes the fund redemption headlines as the stock drops. So a Blue Owl Capital Inc. executive pushed back on recent media reports suggesting the company is permanently halting redemptions in one of its private credit funds. On the same day, it announced the planned sale of $1.4 billion in direct lending investments. Blue Owl disclosed that the board of Blue Owl Capital Corp. II will deliver liquidity to shareholders via quarterly return of capital distributions, replacing future quarterly tender offers. The announcement led to news reports that stated Blue Owl was halting redemptions. That's what you call a sleight of hand. Yeah, that is a little sleight of hand there. Well, we're not really halting redemptions. We're just going to give the money back vis-a-vis a quarterly return of capital distributions. Yeah, yeah. So you'll get your money back. Like, but who's to say how much will those capital distributions be? And if I don't know, if I've got 100 grand invested in this, how long will it take me to get that 100 grand back out of those capital distributions? I would say it would take you maybe a decade, if not longer. So, all right, so we got that. Then we've got this. So, JP Morgan execs say private credit issues appear isolated, but prepared for the worst. Gotta love it. Strains impacting the private credit ecosystem appear isolated currently, but that could quite easily change, and we're prepared for that. Said Troy Rohrbaugh, JP Morgan Chase, the company's co-CEO of commercial and investment banking. Rohrbaugh said other senior JP Morgan executives offered views on private credit and a wide range of additional topics at the bank's company update on February 23rd, which serves as an abbreviated investor day. I'm shocked that people are shocked, really. Addressing disruptions in private credit markets that have ranged from concerns about investor redemptions to worries that competition from AI could undermine the value of loans to software companies. Yeah, I mean, again, there are a lot of problems in this private credit market, and just the fact that he would sit there and say like I'm shocked that people are shocked, and I love how they always well, it's totally isolated. It's totally isolated, nothing to see here. But that could easily change, and we're prepared for the worst. We're prepared for the bottom to drop out on this bad boy. It's just wild. So, and then we get this. So NDFI lending, so banks lending to NDFIs, non-depository financial institutions, that is a big part of the private credit industry, a part of the growth of the private credit industry. Now, what is very troubling here is that this article points out that U.S. banks' NDFI lending pace re-accelerates in the fourth quarter of 2025. So the U.S. banking industry again accelerated its non-depository financial institution lending pace after tapping the brakes in the third quarter of 2025. After growth slowed and investor pressure ratcheted up in 2025's third quarter, growth in loans to NDFIs ticked up again to an industry-wide 7.3% increase for the fourth quarter of 2025. All of the top 20 banks by exposure to NDFI loans increased their loans quarter over quarter, and of those, 7 grew their exposure by over 10%. In total, loans to NDFIs grew $129 billion in the fourth quarter, and compared with all other loans growing $31.38 billion, or just 24.2% of the growth in the NDFI loans. So, I mean, that's pretty crazy. And let's see here. So here are the top 20 U.S. banks by loans to non-depository financial institutions, and no shock, you got the big six, or all the top 6 that are there: J.P. Morgan Chase, Wells Fargo, Bank of America, Citibank, Goldman Sachs, Morgan Stanley, and then you get into the next tier. You get into the PNC Bank, U.S. Bank, Truist Bank, all of the super regional banks. First Citizens Bank and Trust, Capital One. And then we get into State Street, Citizens Bank, BMO Bank, Key Bank, Huntington National Bank, Everbank, Western Alliance Bank, Manufacturer Traders Trust, Regions Bank. So again, I mean, it's just I have said before about the private credit market that it is a beast, and you have to feed the beast, and that's why all of these banks, this is where. For the big banks, this is where the action is right now. This is where a lot of their loan growth is coming from. And so as a result, they're like, I guess all the blow ups so far haven't been enough. The big write down that JP Morgan had to take on Tricolor Holdings and First Brands, the big write down that Barclays had to take, I guess that wasn't enough to kind of scare them into basically saying, hey, maybe we should tap the brakes on this a little bit. No. They're moving full steam ahead here, which is just wild, man. It's just wild. Yeah, it's just crazy. You know, crazy, crazy, crazy. So, all right, now let's get into the inflation prices for a second. So, core wholesale prices rose 0.8% in January, much more than expected. So, you know what? Let me make that a little bit bigger. Okay, there we go. All right. So, core PPI, which excludes volatile food and energy prices, increased a seasonally adjusted 0.8% more than the 0.6% gain in December and well ahead of the Dow Jones consensus estimate for 0.3%. On an all items basis, headline PPI rose 0.5%, also above the forecast for 0.3% and the zero point 0.1 percentage point more than the prior month. For the full year, core wholesale prices accelerated 3.6%, while the headline index posted a 2.9% gain. So this is just PPI versus core PPI. So wholesale prices rose at a faster than expected pace in January, countering hopes that inflation was easing. The Bureau of Labor Statistics reported Friday. The core PPI, which excludes volatile food and energy prices, increased a seasonally adjusted 0.8%. On an all items basis, in other words, the core PPI rose 0.5%. And so stock market futures added to losses following the report. Services prices primarily drove the increase with a 0.8% monthly rise that was the highest since July of 2025. By contrast, goods prices actually fell 0.3%, though core goods prices climbed 0.7%. More than 20% of the increase in services came from margins for professional and commercial equipment wholesaling. On the goods side, energy and food prices both fell while metal prices rose 4.8%. Trade services prices surged 2.5%, helping boost pressures on wholesale inflation. So again, we're talking about services prices that primarily drove this increase. And more than 20% of the increase in services came from margins for professional and commercial equipment wholesaling. So again, I think it's just very important and very interesting to note that. So this was obviously not the inflation report that we were all looking for. And I think this is not going to help getting interest rate reductions from the Federal Reserve, or at least getting additional interest rate reductions from the Federal Reserve. I think they're going to look at these numbers when they go in to, when they look at their March meeting coming up here. I don't think that they are going. I just, based on this, I don't think they're going to cut numbers. I mean, like I said, we got the PCE last week. Now it was for December and not January, but even so, the PCE number came in a little hotter than expected. This January PPI here came in a little hotter than expected. We should get the, let me see here. Are we going to get the CPI next week? I don't see that for next week. So we might maybe the week after we'll get the CPI numbers. But the bottom line is we're going to get the CPI numbers before the next Fed meeting. And because of that, if the CPI numbers come in a little hotter than expected, which you would probably expect them to, given these last two reports that we've just had here on PPI and the PCE, the inflation is probably going to run a little hotter than expected, and that's probably going to kill any chance of another interest rate cut, at least for this coming March meeting from the Fed. So, but like I said, we will keep an eye on that. Now, this was interesting. So UBS downgrades the U.S. stock market. Here's what has the investment bank worried. So UBS downgrades U.S. equities, saying factors that powered years of outperformance are starting to fade. The dollar risk is a central concern as the firm sees asymmetric structural downside risks to the greenback. Another pillar of U.S. stock strength, corporate buybacks, is also losing its edge, the bank said. So UBS's top equity strategist dialed back his view on U.S. stocks, citing mounting risks from a weakening dollar, stretched valuations, and policy turbulence in Washington. Andrew Garthwaite, head of global equity strategy at the investment bank, downgraded American equities to benchmark in a fully invested global equity portfolio, arguing that the factors that powered years of outperformance are starting to fade. The dollar risk is a central concern, Garthwaite wrote. UBS forecast the euro climbed to $1.22 by the end of the first quarter and sees asymmetric structural downside risks to the greenback. Historically, when the dollar's trade-weighted index falls 10%, U.S. equities underperform by roughly 4% in unhedged terms, according to the bank. Foreign markets are trouncing the U.S. this year as a weaker dollar and cheaper valuations draw capital overseas. The MSCI World ex-US index has gained about 8% in 2026, compared with the little changed performance for the S&P 500. Japan's Nikkei has rallied 17% year to date, while the stock's European 600 is up 7%, underscoring a sharp rotation away from American equities. U.S. stocks struggled again Friday as investors fretted over the potential downsides of the artificial intelligence build out and persistent inflation at home. So, again, I don't really see as much issue with the weaker dollar. I think in a lot of ways the weaker dollar actually helps us with trade. So I'm not ready to sit there and say, oh yeah, this is really bad or this is really horrible. But I think there is some truth here to what he's saying in terms of the corporate buybacks losing their edge. Like in other words, corporations buy back their own stock to try to increase their stock price. Well, maybe the buybacks are not having as much bang for their buck, if you will, as that strategy did. But then what are some of the other things here he talks about? Basically they're talking about the stretched valuations, policy turbulence in Washington D.C. Well, again, you have to look at it. Where did the policy turbulence come from? It came from what I think was a horrible ruling on the part of the Supreme Court. The Supreme Court threw all this into turbulence. Now, and again, the Supreme Court, when you go back and look at their opinions on the trade tariffs and what was called the IEEPA, they did not make their case. They didn't make their case. They basically were like, oh yeah, well, we kind of think this or we kind of think that. The dissenting opinions there from Thomas and Alito and Kavanaugh, their dissenting opinions made far more sense than the opinions from the 6 Supreme Court justices that voted for it. And so again, is it policy turbulence coming from the White House? No, I don't see that. I see policy turbulence from a very stupid and flawed decision on the part of the Supreme Court. Now, the stretched valuations, that's a whole different thing there, because you could talk about the big, what is it, the Magnificent Seven, whatever, in the stock market, and how the weighting of those stocks has really gotten out of whack, and that it's Nvidia and Meta and Apple and everybody basically driving up the valuations in the NASDAQ and everything, and how that if those companies begin to go down, they're really going to drag a lot down with them. Just because of the weighting of those stocks. So I think there is a lot of truth in that. Like that is absolutely true. So again, I think that this downgrade is perhaps not without its merits, but I think some of this here is a little overblown. I would say it that way. So, but again, just an interesting development. Now, JP Morgan here basically said that, he's got this high anxiety now over future credit cycles. Now, what did he say? So JP Morgan Chase CEO Jamie Dimon on Monday warned of similarities between the current moment and the years just before the 2008 financial crisis, saying that he's anxious that lofty asset prices are fueling the risk of a coming credit cycle. The bank has more competitors than ever now, and everyone's on offense, the CEO said. My own view is people are getting a little comfortable with it, and that this is real, these high asset prices and high volumes, that we won't have any kind of problem whatsoever, Dimon said during the bank's company update event in New York City. Everyone's coining money and everyone's great, Dimon said. It does feel really good. And then when I think about all the factors taking place, I like to take a deep breath and say, watch out. A swing in the opposite direction is coming, Dimon said, adding he doesn't know when. My anxiety is high over it. I'm not assuaged. by the fact that asset prices are high. In fact, I think that adds to the risk, he said. Unfortunately, we did this in '05 and '06 and '07, almost the same thing, Diamond said. The rising tide was lifting all boats. Everyone was making a lot of money. People were leveraging to the hilt. The sky was the limit. The CEO of the biggest U.S. bank frequently frets over the geopolitical environment or signs of cracks in the credit environment. Amid intense competition to make loans, JP Morgan remains quite cautious. Diamond told investors Monday, "We stick to our own rules," he said. "If the bank loses business because we don't want to underwrite a leveraged loan, so be it. We're not chasing anything." Oh, really? Oh, really? Jamie's not chasing anything. That's quite interesting because I thought I just showed you guys a few minutes ago this article on U.S. banks' NDFI lending pace reaccelerating into the private credit market. And wait for it, who was number one on this list? Oh, it's JP Morgan. That's right. It's JP Morgan Chase is number one on lending to the NDFIs, lending into the private credit market, which Jamie Dimon just said 2 months ago had a bunch of cockroaches running around in it. So that's really interesting from Jamie. If I didn't know better, I would say he was talking out of both sides of his mouth there. On the one hand, he's like, we're sticking to our principles and we're not going to chase anything. And yet on the other hand, he is literally the number one bank in the country dumping the most money into the riskiest market right now. Like, what am I missing? What am I missing on this? It's really ridiculous, I think, of him to get up here and say some of these things. And again, he talks in a lot of anecdotes. The market is going to turn. Well, of course it's going to turn, but nobody has a crystal ball. If we all had a crystal ball, we'd all be worth billions of dollars because we'd know exactly what was going to happen in the market and we'd all know how to play it. But we don't. We don't have a crystal ball. We don't know what's going to happen. But saying that the credit market's going to turn someday. Well, of course it will. The sun's going to come up tomorrow too, and the sky is blue. Like I know, it's like we of course, we know these things. Everything has cycles. The stock market has cycles. Industries have cycles. Business has cycles. Countries have cycles. Everything's got cycles. So again, it's not. It's just wild to me, like some of these comments that he makes. But again, he goes out there and says this stuff, and everybody gets all riled up. Oh, Jamie's all concerned. Jamie's all concerned. Okay. Now, let's switch gears for just a second here because I want to go into this because this is funny. This is funny. I really love this. Okay. So get ready for this. So JP Morgan's lawyers deny the Trump blacklist claims. The bank says CEO Jamie Dimon should not have been named as a defendant and asked for the president's debanking case to move to federal court. So JP Morgan's lawyers come out here on February 20th and basically say, oh, hey, this whole debanking case from President Trump is ridiculous because we didn't debank anything and Jamie shouldn't be on here. And this case should be thrown out, and it's just ridiculous, right? And then 2 days later, JP Morgan concedes it closed Trump's accounts after January 6th attack on the Capitol. Wait, what? JP Morgan acknowledged for the first time that it closed the bank accounts of President Donald Trump and several of his businesses in political and legal aftermath after January 6th. The latest development in a legal saga over the controversial practice of debanking. The acknowledgement came in a court filing submitted this week in Trump's lawsuit against the bank and its leader, Jamie Dimon. The president sued for $5 billion, alleging that his accounts were closed for political reasons, disrupting his business operations. And I think they closed over 20 of his accounts, something like that. But again, this is almost comical here. They're on the one hand, they're literally saying that, oh, this is ridiculous. We didn't do anything to him. This case is totally frivolous. We need to throw this out, whatever. And then literally the next day, they're like, oh yeah, they conceded that, yeah, they closed all his accounts and they debanked him. They did all this too. It's literally like if I got any Dave Chappelle fans out there, if anybody remembers the one of the greatest skits of all time, the Rick James skit from Chappelle Show, when they were interviewing Rick James, and Rick James is like I didn't go in there and stomp on his couch with my muddy boots. And then a second later, he's like, yeah, I remember stomping on his couch with my muddy boots. Cocaine's a hell of a drug. It's like the same thing. We didn't debank him. That didn't happen. I didn't debank him. Yeah, I debanked him. Cocaine's a hell of a drug. It's great. It's great. Oh, you gotta love it. It's fantastic. So, all right. So the debanking case against J.P. Morgan from President Trump continues. I basically, there's no doubt he's probably going to win this case. I really doubt at this point that J.P. Morgan, after openly admitting to this, has got much of a case here. So this is would seem like it's going to head in the president's favor. He may not get $5 billion, but they might come up with some kind of settlement or something on here. But it will add around the conversation of debanking and what that ultimately means and how that plays out. So, we'll see what happens with that. All right. Now, if I can, before we get on to some of our other things here, I just want to switch gears for just a second here. This is the usual time of the program where I like to give everybody the economic indicators that are coming out next week. I like to run through the episodes that I put out this week, and I also like to give everybody some banking news so far for the week. So let us start with our economic indicators, shall we? So and I have the chart up here so everybody can see that. So on Monday, March 2nd, manufacturers Purchasing Managers Index, and we get the Atlanta Fed GDP now for the first quarter of 2026. On Tuesday, March 3rd, we get American Petroleum Institute weekly crude oil stock. On Wednesday, March 4th, we get the ADP non-farm employment change. We get the Services Purchasing Managers Index, the ISM non-manufacturing Purchasing Managers Index. We get the Beige Book at 2 p.m. On Thursday, March 5th, we get the trade balance, the initial jobless claims, continuing jobless claims, non-farm productivity costs, factory orders for January. And then finally, on Friday, March 6th, we get the retail sales, the average hourly earnings, the non-farm payrolls, participation rate, unemployment rate, the U.S. Baker Hughes total rate count, and consumer credit for January. So a lot of economic indicators, a lot of economic information coming out this week. So now let's take a look at some of the banking news, shall we? Home prices increased in December. That's good. Consumer confidence increases in February. That's also great. Wholesale inventories increased in December. That's good. Personal income and spending rise in December. New home sales dropped in December. New home sales fell actually 1.7% in December, but were up 3.8% for the year. Consumer sentiment was up slightly in February. The IRS launches a new web page for tax fraud and scam reporting. That's interesting. So the IRS announced the launch of a web page that allows taxpayers to confidentially report suspected tax fraud, scams, evasion, or other tax-related illegal activities. Regulators tout community bank relief on Capitol Hill. So during testimony at a Senate Banking Committee oversight hearing, federal banking regulators said community bank regulatory relief is a top priority. So that's great. OCC proposes a rule on the Genius Act implementation. So the OCC requested comment on a proposed rule to implement provisions of the Genius Act regarding the issuance of payment stablecoins. Now, I have a copy of this proposed rule. I'm actually reading it over and going through it. I am positive that I will be doing an episode on this proposed rule and basically giving a lot more detail into how the OCC sees basically the Genius Act being implemented, which I think there will be some very interesting details in there. So I will bring that. Like I said, I will put that episode out probably, maybe not this week, probably the following week. So. Community bank net income decreases in the fourth quarter, but it is up overall in 2025. So community banks reported a 3.8% fourth quarter decrease in net income from the previous quarter, but full year net income was up 22.5% in 2025 from the previous year, according to the FDIC's latest quarterly banking profile. Now, I will be doing an episode on the quarterly banking profile this week. That is a quarterly report that comes out from the FDIC. It gives a lot of great information on just the financial performance of the banking industry in general. I always love covering that report. Just a great report to cover, a lot of good information. So I'll be coming out with more details on an episode this week as I cover that. Now, Treasury releases 2 AI resources. So the Treasury Department released the first 2 of 6 recently announced resources to guide AI use in the financial sector. The AI lexicon addresses establishing common definitions for key AI concepts, capabilities, and risk categories, enabling clearer communication across regulatory, technical, legal, and business functions, and supporting more consistent supervision and implementation. The Financial Services AI Risk Management Framework adapts the NIST AI Risk Management Framework to financial services and provides practical tools and reference materials to help institutions evaluate AI use cases, manage risks across the AI lifecycle, and embed accountability, transparency, and resiliency into AI deployment decisions. So there may be some episode coming out covering that, just saying. ICBA, others back changes to bank capital rules. ICBA and other groups express support for banking regulators' continued work to re-examine and repurpose a revised Basel III Endgame rule. So yes, the work on that continues. ICBA supports CRA strategic plan guidance. So ICBA said it supports the OCC's proposed guidance on Community Reinvestment Act strategic plans, which is designed to make the strategic plan option more accessible to and less burdensome for community banks. So, yes, I mean the CRA, the regulators had already proposed changes on that about a year or two ago. Did not go over so well. A lot of people in the banking business just did not like them. It basically got canned once the Trump administration came in, and now they're basically revisiting it again, which we pretty much knew they were going to. I'm just hoping that the changes this time around, whatever they propose, are just a little bit better than what came out the last time. So USDA opens enrollment for farm bridge payments. So the Agricultural Department announced it is opening the enrollment period for the Farmer Bridge Assistance Program, which will provide $11 billion in one-time bridge payments to certain producers in response to temporary trade market disruptions and increased production costs. So that will be helping the farmers out there, no doubt. The Fed should not weaken stress testing regime. So ICBA called on the Federal Reserve to reconsider a proposal that would weaken the stress test regime for the largest banks. Fed requests comments on removal of reputation risk from supervision. So the Federal Reserve requested comments on its proposal to codify the removal of reputation risk from its supervision of banks. So we'll keep an eye on that one. Markup of Farm Bill is postponed until next week. CDFI fund extends effective date for small business loan disclosure policy. So the Community Development Financial Institutions Fund announced an extension of the date when CDFI certification applicants and CDFIs must begin implementing small business loan product disclosures to borrowers. Administration considers requiring banks to collect citizenship info. We talked about that already. OCC approves the ICBA opposed National Trust Charter applications. So the OCC recently approved National Trust Charters for 3 crypto-focused applicants following ICBA's opposition. I talked about this. So Stripe's application for a National Trust Bank charter for a proposed subsidiary called Bridge National Trust Bank was approved. An application by Protego Holdings Corporations for its subsidiary called National Digital Trust Company, that was approved. And then also the application from Fortis DAX, the parent company of Crypto.com, to form Fortis DAX National Trust Bank was also approved. ICBA opposes Affirm Bank's ILC application. So ICBA and the Bank Policy Institute said the FDIC should not issue deposit insurance to Affirm Bank or any other industrial loan company applicant until Congress closes the ILC loophole. ICBA supports the Strong Farm Bill, opposes expansion of FCS financing. And a new op-ed highlights local cost of credit union tax disparity. A new op-ed in Kentucky says the state's budget shortfall could be fixed if credit unions paid taxes like community banks. So still a lot of heat on credit unions and the credit union tax that probably should be. So we'll have more conversation on that. So, okay, now let's get into. I put out 6 episodes this week, so let's get into that. So the first episode I did was actually just a BND live stream bonus episode where I basically just cut the tariff conversation that I did in last week's live stream. I just cut that out, which was about 25 minutes, and I just put that into its own episode. I did that last Sunday. So basically, the Supreme Court of the United States, SCOTUS, struck down President Donald Trump's tariffs that fell under the International Emergency Economic Powers Act, or the IEEPA. This decision by SCOTUS had interjected chaos into President Trump's economic agenda and slows down his ability to bring manufacturing back to the U.S. This decision potentially puts the U.S. on the hook for up to $175 billion in tariff refunds. SCOTUS did not call for or make clear how refunds would be issued in their decision, thus setting up a very messy refund process and years of legal battles. President Trump was defiant, however, in the face of SCOTUS's decision, immediately enacting a 15% global tariff, stating that he would use other existing tariff laws to continue his economic agenda. So that was the conversation I had around the SCOTUS decision last week. And then on Monday, I followed that up with an episode that was basically titled SCOTUS Tariff Fallout Continues. So as the fallout from SCOTUS's decision on tariffs continues, we consider 5 takeaways. Number 1, tariffs are not authorized under the IEEPA, but they are under all other tariffs are okay. Number 2, the refund process is likely going to be a mess. Number 3, the Trump administration is already looking at existing tariff laws to keep the current tariff deals in place. Number 4, in Justice Kavanaugh's dissenting opinion, he stated that other laws probably would allow for Trump's tariffs. And then number 5, justices disagree over how to apply what's called the major questions doctrine. So furthermore, we review several tariff-related charts and economic information. And then finally, we look at some of the big corporations that will seek refunds. So again, if you want the whole tariff conversation, if you want to get up to date with the tariff conversation real quick, just look at those 2 episodes. Go view those 2 episodes, the BND Strategy Room bonus called Tariff Madness, and the follow-up episode, SCOTUS Tariff Fallout Continues. So, but if you watch those 2 episodes, probably about 40 minutes of time there between the 2 of them, and basically you'll be all caught up. You'll understand everything that's going on in the tariff conversation, and you will be good to go. So, okay, now following that, on Tuesday, I basically continued the conversation that I've been having on prediction markets. And this episode was titled Prediction Markets, Gambling and Trading Blur Together, and the Sports Betting Zero-Sum Game. So the conversation around prediction markets continues as the CFTC is ready to go to court and fight states. Not fight prediction markets, but fight the states over who has jurisdiction when it comes to enforcement and regulation. In addition, we look at why options traders are moving to prediction markets. The blurring of the lines between trading and gambling continues. Finally, we consider how sports betting is a zero-sum game. What does this ultimately do to the young men that are fueling all this action? So now this episode basically continued on from two other episodes that I had done over the last few weeks. One was called The Rise of Prediction Markets, and the other one was called Are Prediction Markets Trading or Gambling? Both those episodes proved very popular. I got a lot of great comments and feedback on those episodes. So if you are interested in maybe learning a little bit more about prediction markets, things like Kalshi and Polymarket, if you want to know kind of what's going on there with this blurring between trading and just straight up gambling, check out these episodes, because the reason why I'm doing episodes on prediction markets is because the growth, you cannot ignore the massive growth in prediction markets. You cannot ignore the massive growth in online gambling, whether it's through FanDuel and what's the other one? I'm drawing a blank on the other one. There's FanDuel and DraftKings. That's it. FanDuel, and you can't ignore the growth of FanDuel and DraftKings. You can't ignore the age group, the young men that have really jumped into this thing. You can't ignore that. So, and I just feel like prediction markets with where things are going with trading. Goldman Sachs, very interested in getting into prediction markets. You've got Susquehanna, the trading firm, wants to get into prediction markets in a big way. Then you've got Coinbase and Robinhood basically adding prediction markets to their apps, wanting to make being able to the use of prediction markets more available to all their customers. So there's no doubt that the prediction markets are going to continue to grow. The question is, what does the CFTC do about this? What are the ultimate influences on this? Like I believe this is ultimately a very bad thing, because in my mind, this is not trading. This is just, prediction markets to me are pure gambling. They're not trading. And again, I get in that episode, I get into this whole conversation on why options traders are moving to prediction markets. So again, I think it's an interesting conversation. If you want to understand that blurring of lines between trading and gambling, like I said, go in and check that out. All right, then on Wednesday, I did this episode was for the ladies. So female power, a look at the 154 billionaire women in the United States. So there are now 154 billionaire women in the U.S. These women have a comparable median net worth to the men of around $2 billion, while 154 billionaire women they are a smaller number than the 981 male billionaires in the U.S. Their numbers are growing. So now the big question is, how did these women amass their fortunes? Well, most of the money was inherited, but the number of self-made entrepreneurs is really growing. So the article goes through four main categories: heiresses, CEOs and entrepreneurs, philanthropic ex-wives and widows, and young entertainers. So I thought this was a really interesting episode. I was hoping that I was kind of trying something a little different there. I was hoping, maybe attract some more of the female viewers, as my audience really tends to skew toward a male demographic. So like I said, just figured I'd throw that out there and see if people find that one interesting. Okay. And then on Thursday and Friday, I had what I thought were some very interesting ones. So last week, I did an episode on I thought I had a different framework. Maybe I did. Maybe I did. Maybe I didn't. I was just looking for something here for a second. Yeah, I thought I did it. Anyway, okay. So on Thursday, I did an episode on a very specific framework called Can the Stark, and that's spelled STARC, the Stark. Kind of nice play on words, kind of like Tony Stark, Iron Man. Can the Stark framework help banks to better evaluate fintech partners? So vetting and assessing fintech partners can be a very difficult task for community banks. In seeking a framework to assist community banks in this effort, a new organization called the Coalition for Financial Ecosystem Standards, or the CFES, was created in March of 2025. Now, CFES has now rolled out the Standardized Assessment for Risk Management and Compliance, or the STARC framework. STARC can certify that a fintech has achieved dozens of measurable standards in core compliance areas, ranging from BSA and AML to compliance management systems, operational risk, and compliant handling. Community bank relationships and usage of fintechs are only going to grow in the future. Having a framework that provides more confidence around the vetting and assessment of fintechs before you sign a contract is a major plus. After all, no community bank wants to end up in the regulatory penalty box because of poor vendor management due diligence. So again, thought this was a really interesting article looking at what is called this new STARC framework, hopefully giving community banks a better way to evaluate their potential fintech partners. And then finally, on Friday, I did an episode called Can Banks Use Amazon's Strategy to Attract Deposits from Gen Z and Millennials? So checking accounts have become a commoditized product for banks. That's no secret. That's been known for decades. But How can banks unlock a value creating growth engine and protect market share from new competitors such as neobanks? Now, I just did an episode on neobanks. If you want to go check that out, I think, again, I think neobanks are a very interesting topic. But using the Amazon strategy of bundling products through a subscription service feature might be the answer. Amazon is currently offering basically a checking account bundle with additional services for a monthly fee. Now, what is really interesting is that based on research conducted by Cornerstone Advisors, love those guys over there at Cornerstone Advisors. Ron, Steve, all the guys over there, great group. So Cornerstone conducted this research, and they found that 37% of young millennials and 46% of old millennials would ditch their current bank to move to Amazon. There is a willingness on the part of consumers to pay for a bundled checking account. However, it falls on banks to create a value proposition for customers. Furthermore, banks are really counting on Gen Z and millennials for growing deposits in 2026, but what are they looking for in a financial institution? I think we really have to ask that question. So again, I think this strategy is really interesting. This strategy of, bundling services with a checking account for a fee. Again, after research would suggest that a lot of consumers out there are willing to do this, but you have to create, as the bank has to create that value proposition for the customer. And if they can do that, like I said at the beginning here, they may be able to unlock a major value creating growth engine and protect market share at the same time. So again, I think something to really think about, something to really take into consideration. So, okay, those were the 6 episodes that I put out this week. So that's our banking news and everything, everybody. So now we're going to get back to our articles and everything here. So we are going to jump into the Jane Street conversation. So there were a whole bunch of tweeting here going out on Jane Street this week. And I'm going to show you guys a couple of articles here, one from the Wall Street Journal and one from, but basically I'm just going to read you guys a couple things here. So, and this is from Zero Hedge, posting here on, let me make this a little bit bigger here. See if we can see that a little bit. Okay, and there it is. Jane Street was behind the 2022 crypto winter, destroying Terraform by first depegging the token and destroying the ecosystem, then pretending it would rescue Terra while effectively it was soaking up what little value remained. I mean, this is pretty wild stuff here. So, Jane Street was sued for alleged insider trading by the administrator, winding up the affairs of Terraform Labs, the firm whose $40 billion collapse in 2022 roiled the crypto markets and contributed to the collapse of FTX. The irony of this cannot be lost. Okay, I'm gonna get into a conversation here in a second. So I want people to understand the founder and creator of FTX was one gentleman named SBF, Sam Bankman-Fried. Where's Sam Bankman-Fried right now? He's rotting in a prison cell. Now, Sam Bankman-Fried, where did he come from? Where did he learn his trading craft? Oh, that's right. He worked for Jane Street. Everything he learned about trading, he learned at Jane Street. And then it was at Jane Street where he was trading crypto that he decided to leave to go create FTX. And then he created Alameda Financial Research, which was a hedge fund, which did a lot of trading with, wait for it, Jane Street. So there's huge connections there. So the irony that Jane Street played a major role in orchestrating the downfall of Terraform Labs, or Terra USD, the stablecoin, which ultimately then led to the collapse of FTX, is like that irony cannot be lost on you. It goes back to you reap what you sow in this world, right? The Jane Street defendant scheme was not a complicated one. They leveraged connections with Terraform insiders to learn material non-public information about Terraform that gave Jane Street a massive advantage in the market. Using that insider information, Jane Street sold off its UST at the opportune moment on May 7th, 2022, to maximize its own profits and avoid substantial losses. Within hours of Jane Street selling its UST holdings, UST was depegged from $1, and the entire Terraform ecosystem, including the UST and the Luna cryptocurrencies, was in a death spiral. Pretty amazing. And then we get into this little post here, and this is from the actual lawsuit filing here. So in short, Jane Street used its connections with Terraform insiders to learn material non-public information about Terraform that gave it a massive advantage in the market, using that information to maximize its own profits and avoid losses suffered by other investors who did not have this confidential information. And in doing so, helped cause the complete collapse of the Terraform ecosystem. As if that weren't enough, and despite its own traders' misgivings, Jane Street then used confidential information it learned to then, like I said, suck up the remaining value, as it were. So, and then this is interesting, and this was from another person on X here from Bark. So Jane Street was running an algorithm that dumped Bitcoin every single morning at 10 a.m. every day for months, crashing the price, liquidating retail, buying back lower, rinse and repeat. The second they got sued, it stopped. The 10 a.m. dump disappeared. Now Bitcoin just had the best day in months. One trading firm. That's all it took to suppress the entire crypto market for months. Now ask yourself how much of the crypto price action is even real? How many people panic sold because the charts looked terrible? How many people got liquidated? How many billions were taken from the regular people by a single trading desk? And this is just the first one to get caught so far. It's about to get very interesting. Yes, so basically Jane Street was dumping Bitcoin every single morning at 10 a.m. every day, and then for months crashing the price. And as soon as they got stopped here, or as soon as they got busted here, that all stopped, and the 10 a.m. dump disappeared. And then what happened? Bitcoin's price immediately started to rise. Immediately. So now let's take a look at a couple of these articles here. So Jane Street accused of insider trading that helped collapse Terraform. So the court-appointed administrator of Do Kwon's Terraform Labs alleged that Jane Street used non-public information from Terraform insiders to trade. And now this is Do Kwon. He was the investor and founder of Terra USD, Terraform Labs, basically. So the administrator winding down Do Kwon's Terraform Labs has sued Jane Street, alleging that the high-speed trading giant engaged in insider trading to profit unlawfully from and ultimately hasten the crypto empire's collapse. Todd Snyder, the plan administrator appointed by a bankruptcy court, is seeking damages from Jane Street, its co-founder Robert Granieri, and employees Bryce Pratt and Michael Huang. In a heavily redacted complaint, the administrator alleged Monday in Manhattan's federal court that Jane Street used material non-public information from Terraform insiders to front-run trading that sped up Terraform's demise. Terraform collapsed in May of 2022 when its Terra USD cryptocurrency, a so-called algorithmic stablecoin, lost its peg to the dollar. A sister token called Luna also plummeted to near zero within days of the depeg. Their $40 billion crash hurt hundreds of thousands of investors worldwide, some of whom lost their life savings nearly overnight. The implosion also triggered a chain reaction that toppled companies across the crypto sector, ultimately culminating in the collapse of Sam Bankman-Fried's FTX exchange. Approximately 17 companies, crypto-related firms, failed, including Gemini, Genesis, Voyager, BlockFi, Celsius, a whole bunch of crypto firms went down and blew up in this what became known as the crypto winter of 2022. Terraforms filed for bankruptcy in January of 2024, and a wind-down trust was formally established later that year. Kwon, the brash entrepreneur who founded Terraforms in 2018, is serving a 15-year prison sentence after pleading guilty to 2 criminal counts in August. Jane Street abused market relationships to rig the market in its favor during one of the most consequential events in crypto history, Snyder said in a statement. On behalf of injured parties, we will pursue all avenues supported by the facts and the law against those who exploited their position and reaped substantial profits at the expense of Terraform Labs creditors. This desperate suit is a transparent attempt to extract money when it is well established that the losses suffered by Terra and Luna holders were the result of a multi-billion-dollar fraud perpetrated by the management of Terraform Labs, said a spokesman for Jane Street. We will defend ourselves vigorously against these baseless opportunistic claims. By late 2018, Jane Street had signed up to trade directly with Terraform, but its trading in Terraform's tokens didn't take off until February of 2022, when Jane Street sent Bryce Pratt, a former intern at Terraform, to establish lines of communication with his former Terraform colleagues, according to the lawsuit. Among Pratt's communications with Terraform was a group chat he set up with his former colleagues, including a software engineer and the head of business development at Terraform. The group named the chat Bryce's Secret and used it as a way to channel Terraform-related information back to Jane Street, per the lawsuit. Again, yeah, I mean, this just gets crazy. Now let's take a look at Zero Hedge. What did Zero Hedge have to say? Now, I always love Zero Hedge's commentary on this. So for years, literally, we have been pounding the table and pointing out, and it's got crossed out, market rigging and manipulation irregularities in the crypto markets, which, for reasons of our own, we attributed to one of the world's foremost high-frequency trading shops and most profitable market makers in the world, if not India, Jane Street. Below is an example from 2023, and there are hundreds of others. So, and I would remind people, Jane Street just got kicked out of India. I mean, they got kicked out of the whole country because of why? Market manipulation, doing all kinds of shady dealings. So Jane Street just got kicked out of India. They just got the boot from India. That's why he mentions India. And now they find themselves in hot water with this lawsuit. So, and again, Jane Street was sued for alleged insider trading. Let's see here. Restructuring Group claimed in a redacted complaint filed Monday in Manhattan Federal Court, illegally using this information allowed Jane Street to unwind hundreds of millions of dollars in potential exposure at precisely the right time, mere hours before the Terraform ecosystem collapsed. For those lucky enough to remember, Terraform imploded when its stablecoin USD lost its peg to the US dollar, leading to the collapse of its sister token Luna. The failure set off a chain reaction across the crypto industry, ultimately sending Bitcoin plunging below 20,000. Terraform co-founder went to jail. Terraform filed for bankruptcy. Let's see here. Snyder was tapped to administer a trust to maximize the recovery for Terraform's investors and creditors and to close out its operations. As part of his work, Snyder made a stark realization, one which we were aware of all along. Jane Street abused market relationships to rig the market in its favor during one of the most consequential events in crypto history. So here are some of the shocking details that the suit alleges. So again, it gets into some of the stuff, the Bryce's Secret, stuff we just talked about. Specifically on May 7th, 2022 at 5:44 p.m., Terraform withdrew 150 million Terra USD from the Curve 3 pool, a liquidity pool where stablecoins could be exchanged one for the other. Less than 10 minutes after Terraform's withdrawal, which hadn't been publicly announced to the market, a crypto wallet that some analysts have linked to Jane Street withdrew 85 million of Terra USD from the same liquidity pool, the complaint alleges. The next day, Quan said publicly that the 150 million withdrawal was meant to move Terra USD to a new liquidity pool for stablecoins. However, the exact timing of activities associated with the new liquidity pool, including any withdrawals from the Curve 3 pool, wasn't public knowledge. The trades accelerated the collapse of Terraform by adding selling pressure at a critical moment while allowing Jane Street to profit or avoid massive losses. Now, I will tell people, that $85 million withdrawal, there was speculation around that for years as to who was that did that. I mean, that everybody recognized that immediately as one of the big catalysts for what drove this and why it happened. And here it turns out it was probably Jane Street that did this. And then it didn't end there, however. And after the May 7th trade, Jane Street continued to use confidential information, including what it learned from Jump Trading, to trade Terra USD to reap more profits, the lawsuit said. So on May 9th, while Terra USD was depegged but not fully collapsed, Pratt set up a group message with Quan, Huang, and others at Jane Street, expressing the firm's interest in bidding on either Bitcoin or the Luna token. Quan responded that Bill DeSimona, co-founder of The Jump, should have reached out to Jane Street to discuss a fundraise for Terraform. Snyder's lawsuit against Jane Street is part of a broader effort by the Terraform wind-down administrator to pursue parties allegedly involved in or profiting from the collapse. In December 2025, Snyder filed a separate $4 billion lawsuit against Jump Trading, another giant high-frequency trading firm, a market maker, accusing it of market manipulation, self-dealing, and helping accelerate the Terra crash through similar alleged misconduct. A Jane Street spokesperson told Bloomberg the suit is called the suit desperate and a transparent attempt to extract money. So we shall see. Now, here is the actual lawsuit itself. You can find this if you're interested. I don't know if you're interested in looking it up. You could find it at www.scribd.com. That would be scribd.com/document/ 10028191113/Jane-Street-lawsuit if you're interested in looking this up. So so again, I mean, this is just this is just massively wild. And what I find so interesting about, and again, shameless plug here, if you've never watched my crypto series, I highly suggest you go watch my crypto series. I've now got about 35 episodes in the crypto series, but if you go back and watch the first 5 or 6 episodes of the crypto series, I get into all of this. I get into the crypto winter of 2026 and how I feel that it led to the banking crisis and the banking failures that we saw in the spring of 2023. What I find interesting is that the genesis of the crypto winter, it keeps changing. I did another episode probably about a couple months ago where in the crypto series where I talked about, a possible, we had another hedge fund that was involved in some dirty dealings early on that may have added a lot of stress to the situation. And that kind of changed the picture for what we thought might have caused this whole crypto winter of 2026. So now we get this. So it's just amazing to me how every year that goes by here, the last two years, we keep finding out new things about what may have ultimately triggered this whole thing and caused this whole collapse. Now, that's not to say, I mean, Do Kwon is in prison for 15 years. That's not to say he's innocent. This doesn't prove, none of this proves him innocent. It just proves that again, going back to 2022, you had a whole lot of, crazy interests. I'll put it that way. A lot of crazy motives on a lot of parties in the crypto world that just caused that. Basically, it was the old saying, "Pigs at the trough." Just all these pigs at the trough, and of course, pigs eventually get slaughtered. And that's basically what happened. And it became a cesspool of companies just trying to see who was going to shaft the other one first. And I think that's just wild to see a lot of this play out. And obviously, this is going to get real interesting. Obviously, when they have this lawsuit, when this gets to court, when the CEO, Mr. Granieri from Jane Street, when he's got to get on there. Now, here's another thing. So this book right here, and I talk about this in the crypto series, specifically the crypto winter, and I did a book review on this. This is called Going Infinite. This is by Michael Lewis. Michael Lewis, obviously very famous guy for writing Moneyball. He wrote Flash Boys. He wrote The Big Short. Michael Lewis is obviously super successful author, has written a lot of books that have become movies that everybody knows. But amazingly enough, Michael Lewis was actually with Sam Bankman-Fried. He was writing a book about FTX and the crypto market, and he was with Sam Bankman-Fried right at the moment that everything collapsed. He was right there in September, October, November of 2022. He was right there with him. So he literally ended up, as fate would have it, he literally ended up with a front row seat to the entire collapse of FTX, and he had tremendous access to Sam Bankman-Fried. And he talks about all that in the book here. Now, some of the interesting things he says in the book there, he talks about Jane Street. And he talks about Sam Bankman-Fried's background, SBF's background. He talks about how he worked at Jane Street and how that's how he learned all this stuff. And he talks about how Jane Street, their whole MO was to fly under the radar and to stay. They hate press. Jane Street absolutely hates press. They want no press. They don't ever want to be. They feel like because they're a shady firm. They're a shady firm. They do all kinds of shady stuff, and their MO is basically shafting everybody in the market they possibly can. And the irony of that is that they are what do you call it? They are EAs out in Silicon Valley and in the tech world. You have this thing called EA, what is it? Altruistic. This is going to kill me now. Somebody out there's got to know this off the top of their head. But the EA movement is basically it's an altruistic movement in which you basically, it's like, we are going to take money and we're going to do the good things for the world, right? We're going to take all this money, we're going to do all this good thing for the world. The problem is that that's not really how these people operate. These people operate in a very selfish capacity, and it's I need to get uber rich, and then maybe I'll do something for the world. But again, it's this they have this ideology of it's called EA, effective. I think it's effective altruists. I think that's what it is. I'll have to double check that. I'll come back when I come back next live stream. I'll talk about this a little bit more, but I think it's effective altruists, EA. And the EA thing it's kind of a wild ideology, but I believe that the ideology to be all BS. And again, if you read the book and you get all that, you'll understand that whole background there and all this kind of wildness. So all right, let's move on to some other things here now. And like I said, we'll keep an eye on the Jane Street thing. Like I said, I'll bring you guys a lot more information on that as it all unfolds. Okay, a little bit of information here on obviously I'm continuing my conversation here on prediction markets a little bit. So Kalshi dealt a major setback in court fight to remain in Nevada. So a federal appeals court rejected Kalshi's bid for a stay on Nevada's effort to block the platform. National debate over the industry's regulation heats up. So in Nevada, Kalshi suffered a blow in its battle to remain available in Nevada as a federal appeals court rejected its request for a stay on the state's efforts to block the prediction markets platform. The case is being followed closely as a debate heats up over the proper way to regulate the nascent and fast-growing prediction markets industry. Battle lines have formed between officials at the federal and state level who say buying and selling event contracts on platforms like Kalshi, including on sports, is distinct from online betting, and those who see them as one and the same. So Nevada, the country's gambling capital, has emerged as a key battleground. The state is arguing that Kalshi must obtain gaming licenses to keep operating there. Kalshi had filed a motion to the U.S. Appeals Court in Las Vegas seeking an administrative stay on Nevada's civil enforcement case against the company. Within hours of Tuesday's ruling, the State Gaming Control Board filed its enforcement proceedings against Kalshi in Nevada State Court. The case may ultimately force Kalshi to leave Nevada. So again, we'll see what happens with this. But this just happened on February 17th, and this is obviously a big blow to Kalshi, and that court case will continue. Then we got this week. So senators tell the CFTC to make clear ban on prediction market contracts involving deaths. So 6 Democratic senators told the Commodity Futures Trading Commission in a previously unreported letter that they have strong concerns about prediction market contracts that incentivize physical injury or death, saying the contracts present dangerous national security risks. The senators urged the CFT chairman, Michael Selig, to clearly reiterate that the CFTC will categorically prohibit any contract that resolves upon or closely correlates to an individual's death. This letter was sent to prediction markets such as Polymarket and Kalshi, having become increasingly popular. So that's kind of disturbing there, right? And then finally here, Kalshi fines former gubernatorial candidate, Mr. Beast employee on prediction wagers. The prediction market platform is taking action against potential insider trading and market manipulation. So a former California gubernatorial candidate and a video editor for YouTube streamer Mr. Beast were fined by Kalshi for violating its rules for making prediction market wagers on its platform. Their fines were the first disciplinary actions to be disclosed publicly by Kalshi, the company said. Kyle Langford, a Republican candidate for governor in California who said this year he was dropping out of the race, was fined $2,200 basically, including the amount related to his trades and penalties of $2,000, and banned from the platform for 5 years after posting a video on X seemingly showing him betting on his victory, according to a notice posted on Kalshi's website. In January, he filed to run for a House seat as a Democrat, according to the Federal Elections Commission. Kalshi prohibits candidates in a political race from making bets in markets related to their own elections, as well as those employed by political action committees. So Kalshi also invoked disciplinary action against Artem Kaptur, who traded around $4,000 on markets tied to Mr. Beast's videos while working for the YouTube star. Kalshi said it fined the user $20,000, including his profits and penalties of $15,000, and enacted a 2-year account suspension. A spokesperson for Beast Industries, which oversees Mr. Beast's business ventures, said the firm prohibits its employees from making prediction market wagers using proprietary company information and has launched its own investigation into the matter. The spokesperson declined to comment on whether Kaptur is still an employee of Beast Industries. So what does this ultimately mean, though? When you look at this, what do you take out of these articles here? So let's go back for a second here. So Kalshi gets dealt this major setback in court in Nevada. They may get kicked out of Nevada. They may have to get a gambling license if they want to stay in Nevada. Then we go into this, senators. Now you've got Republican and Democratic senators looking at the prediction markets. They're telling the CFTC chief, hey, you got to go specifically look at these bets that deal with death. You got to tell them they got to knock this stuff off. And now you've got Kalshi going out and actually finding a few people, a couple easy cases going after. So this is called Kalshi, basically throwing a bone back to the CFTC and to the state, regulators, basically saying, hey guys, look, you don't need to police us because we're policing our customers. Okay, we're making sure that people are doing things the right way, and if they're not, then we're fining them and we're kicking them off our platform. So this is them trying to show that, hey, they're being responsible in what they're doing here, and to basically say, hey, back off, everybody, back off. So ultimately, do I think this is going to work for Kalshi? No, I don't. I think this is it's a cheap trick on their part, and I don't really think it's going to bail them out here in this case. So, but undoubtedly more to come on prediction markets, and I'll continue that conversation as it comes up. Now, all right, let's look at this for a minute here. All right. I'm going to kind of run through. I got a couple stuff left here. Hang with me here for another 20 minutes or so, guys. I got this AI conversation. I want to talk about the Epstein fallout, a little bit of tariff news, and then I got some banking articles I want to run through real quick at the end. So, like I said, just hang with me here for probably about another 25 minutes, and I'll get through all this stuff here. So, let's go into the AI conversation here for a minute. So, very interesting developments here, and this came out last night. So, well, I shouldn't say that. The argument between Anthropic and the government, particularly the Pentagon, that had been raging kind of all week, but then it came to a head last night. So Anthropic says that it rejected the Pentagon's AI demands. Anthropic said the Department of War threatened to designate the company as a supply chain risk. Now, Anthropic on February 26th rejected the Pentagon's request to allow unrestricted use of its Claude AI model, citing concerns that the technology could be used for mass domestic surveillance or fully autonomous weapons. Anthropic CEO Dario Amodei said in a lengthy blog post that use cases such as mass surveillance and the development of autonomous weapons have never been included in the company's contracts with the Pentagon. Amodei said those two applications are simply outside the bounds of what today's technology can safely and reliably do, and warned that in a narrow set of cases, artificial intelligence may erode democratic values. Well, golly gee, maybe you should have thought about that first, right? Did you not think the government was going to look to use AI for those purposes? I mean, I thought that absolute power corrupts, and that that power corrupts, and absolute power corrupts absolutely. So you hand them the keys to the kingdom, and then you're upset that they come in and take control and kick you out. Like what did you think was going to happen? Did you not think when the Pentagon came to you and said, "Hey, can you create AI to fly drones and amphibious like submarines and have other land vehicles"? Did you think that they weren't going to want to make those fully autonomous weapons at some point? I mean, come on. I mean, seriously. What? I mean, were you that stupid? You didn't think that was going to happen? And then at the very end, when you realized that that's where it was going, all of a sudden now you grow a conscience and you're like, oh man, we can't allow this to happen. We can't do this. What's going on here? It's like, well, idiot. Maybe you shouldn't have gone down this road. Maybe your greed shouldn't have forced you to go on down this road in the first place. So then this happens. Trump administration blacklists Anthropic as AI firm refuses Pentagon demands. So President Donald Trump ordered the U.S. government agencies to immediately cease using technology from the AI company Anthropic. The AI startup faces pressure by the Defense Department to comply with demands that it can use the company's technology without restrictions sought by Anthropic. Defense Secretary Pete Hegseth, soon after Trump's order, said he was ordering the Pentagon to designate Anthropic a supply chain risk to national security after the AI startup refused to comply with demands about the use of its technology. Obviously, if Anthropic doesn't decide to play ball now, this is going to cripple their company. This is going to cripple them. And then, of course, this scumbag, not missing a beat, he jumps right in. So OpenAI strikes a deal with the Pentagon hours after rival Anthropic was blacklisted by Trump. And since this guy, Sam Altman, is a total sociopath and he could care less how many people he maims and kills on the way to his billionaire glory, this guy is happy to he's happy to give the government whatever they want. If this means Uber business for him, if this means making him a multi-billionaire and putting him into the billionaire class, he is happy to do it. He would step on his mother in a minute, guaranteed, to get one step ahead. So OpenAI CEO Sam Altman said on X that his company has come to terms with the Defense Department for use of its models in their classified network. Of course he has. The post landed hours after rival Anthropic was shut out by the Trump administration. So OpenAI they couldn't wait to run right in there. So they have jumped on to the train. So again, very, very interesting. I think that this will get more interesting. I mean, even though OpenAI struck this deal, I mean, Anthropic does have, I'm sure, existing contracts and everything with the Pentagon. And, I think it's always possible that Anthropic might change their tune here, but who knows? But yeah, we'll keep an eye on that one to see how that plays out. And then continuing the AI conversation here. So then we had Jack Dorsey, the co-founder of Block, which used to be Square, and now it's Block. Now Block owns Cash App, of course. And Jack Dorsey, the founder and former owner of Twitter, which is now X. So Jack Dorsey, he cut 40% of his workforce this week, or 4,000 people, because he said he's got all the AI has just figured it out. Now, I'm calling BS on that, and we're going to see in just a second here why I feel that way. So, how Jack Dorsey explained cutting almost half of Block staff. The co-founder says that fewer employees is better in the AI age. Now, he says here that basically this isn't about cost cutting costs. Dorsey said Block, which owns Square and Cash App, is financially sound. Instead, the tech entrepreneur argues that companies need flatter structures and fewer employees to thrive in the AI era. Intelligence tools have changed what it means to build and run a company, Dorsey said Thursday on a call with analysts. A significantly smaller team using the tools we're building can do more and do it better. Block is already seeing the change internally, he added, and intelligence tool capabilities are compounding faster every single week. Now, here's the thing. Block's workforce had surged. Block's employees yearly. So look at what happened here. So 2020, Block had what, 5,000 employees? And then what happened here in 2021, 2022, and 2023? Their employees surged to over 13,000. He went from 5,000 to over 13,000 in 3 years. Do you think you overhired? Do you think maybe you overhired a little bit and now you need to bring that head count down? So he cut it from basically 13,000 down to 9,000 because he's super top heavy. And I wouldn't doubt if he cuts another 3,000 people. I wouldn't be surprised if he tries to bring this down to 8,000 employees. Block's workforce surged, wait for it, during the COVID-19 pandemic as the company built out its Cash App business alongside Square. The payments firm ended 2019 with 3,839 employers, but employed basically 13,000 people by the end of 2023. So, I mean, the cuts announced Thursday will bring its workforce back to levels last seen during 2021. You wait for it. Here it is. Yes, we overhired during COVID, Dorsey wrote on X in response to a user highlighting the company's pandemic era additions. He attributed the headcount growth to building two separate company structures and adding complexity by pushing into new lines of work. And then he goes on to say, better to move fast than slow, a harbinger for US Inc. Cut means changes for customers too, and then a risky move. Dorsey acknowledged that such a big cull could risk Block's ability to serve its customers in the short term, but he remains defiant. Listen, I think a lot of this AI conversation is BS. I think this whole thing from Jack Dorsey this week of oh, I cut all these people because I built all these AI bots around the company, and now that I have all this AI, I don't need all these people because the AI can do their job. I think that's just BS. I'm sorry. I think it's BS. And why do I think it's BS? Well, I did a 4-part series on AI. If anybody wants to go look at that, I did a 4-part AI series. Basically, I covered a whole bunch of reports from MIT and a couple other places that basically said 97% of companies out there that have invested tens of millions of dollars in AI, wait for it, are seeing no profit. They are making no money off. Nobody's making money off of AI. Nobody is making money off of AI. Nobody has figured out how to make money off of AI. Now, what I have always said is the best application for AI right now is making companies more efficient. However, what have I seen in the last couple of months? Well, there have been series of articles in the last couple of months, basically saying companies have to go back and fix what now is being known as AI slop. Okay, they asked the AI to do something, the AI messed it all up, and then they have to spend the time to go back and fix all the stuff that AI messed up. So between the fact that all these companies, that hundreds of companies out there have invested tens of millions of dollars, billions of dollars collectively in AI and have seen zero profit from all this AI investment, and yet they're also dealing with all of this AI slop, it is very difficult for me to believe that magically Jack Dorsey is going, oh, yeah, I'm cutting 4,000 people because I created all these great AI bots that can do all their work for them. Like no, I don't believe that. I think this is a classic example of he overhired, he hired way too many people, and he needed to cut those people, and he needed an excuse for cutting the people. And AI sounds great right now. Hey, we're working on all these AI bots, and so we cut all these people, and we don't need them, whatever. Now, to be fair, do I think that he is working on AI and he has all these AI bots and everything? Absolutely. Absolutely. He is absolutely working on all this AI stuff. I don't doubt that for 1 minute. Will AI perhaps eventually in the next couple of years really help to create efficiencies and scale and help them grow their business? Probably it will. But again, I just am not buying into this art. I'm sorry. People can you can disagree with me. Feel free to put your comments up on the live stream on this video. I just do not believe this whole argument of like AI is just going to eat all of our lunch tomorrow. It's going to take all the knowledge work. It's going to kill all the white collar workers. I'm sorry. I just don't buy it. I just don't buy it. As a matter of fact, I think there is a greater chance that you could see these AI companies, because of the amount of money that they're spending on the AI data centers. Like I think there's a greater chance that all of this blows up in their face before they start to see AI make all these, massive leaps that they're hoping and praying that it's going to make. And you have to remember something too. I keep saying this. These people are salespeople. They have to make you believe that AI is going to do all these magical things, because if you don't believe that, you're not going to buy their stock, you're not going to buy their debt, you're not going to invest in their company, which is going to allow them to raise more money to go on to this crazy data center run. Okay, that's the name of the game. They have to make you believe. They have to put out all this stuff saying how great and wonderful this all is, but yet all the research, all the things that we are seeing says something very different. So, and again, everyone can be free to disagree. They could be totally free to disagree with me. And look, and I'm not saying that Jack Dorsey's the only person here. We've seen there are a lot of companies out there that are on the AI train that are basically like, oh my gosh, we got to cut people. Corporations are very interesting things. Very interesting. If you want to say animals, are very interesting animals, very interesting things. The corporation, because corporate CEOs, they will look on all of the, all the CNBC interviews, the Bloomberg interviews, the call reports, the quarterly earnings calls, like all this kind of stuff. They will watch, they track. What are the keywords being used by all the other CEOs? What are all the things that they're saying out there? Everybody, AI is super hot. Everybody likes to mention whatever the hot thing is in all their call reports. Okay. Because nobody wants to feel like they're not with it, or they're not hip, or they're not doing all the things that everybody else is doing, because they know they'll immediately get, like, if you did a call report and you didn't mention AI one time, you're immediately going to get a question from an analyst who's going to be like, well, what the hell? Like, why didn't you mention AI? What's wrong with you guys? You're not on the AI train. You're not doing this. What's going on? So that's just how a lot of this stuff works. So anyway, all right, that's my little conversation. Let's keep looking at some things here. So a couple more things on the AI thing here. So how the Fed is making AI durable. So Fed Governor Christopher Waller likens the rise of AI to the advent of ATMs, which shifted human effort to higher value work. But fellow Governor Lisa Cook warned of labor market costs tied to AI. So again, here they just kind of continue the conversation. Christopher Waller saying that, oh yeah, like AI is gonna help us. It's gonna make us more efficient. We're gonna do better things with it. And then obviously Fed Governor Lisa Cook is basically sitting there saying, yeah, but there could be a big cost to this because it could take away a lot of jobs. So that's the gist of what they're saying there. Now here's the interesting thing here. Now we get into kind of the data center talk on AI a little bit. So tech bosses to meet at White House and pledge their data centers won't boost electricity bills. President Trump announced the rate ratepayer protection pledge during his State of the Union address. So leaders in big tech are expected to meet with President Donald Trump at the White House this week coming up to pledge that their data centers will not increase the energy bills of Americans living near the facilities. Major tech companies will join President Trump at the White House next week to formally sign the ratepayer protection pledge that he announced during his historic State of the Union address. A White House official told the Epoch Times the March 4th event will include representatives from Amazon, Google, Meta, Microsoft, XAI, Oracle, and OpenAI. The initiative will require massive companies to build, bring, or buy their own power supply for new artificial intelligence data centers in order to avoid causing Americans' electricity bills to skyrocket. President Trump is committed to ensuring American AI dominance while simultaneously lowering costs for working families. Trump first revealed the plans during his wide-ranging and record-breaking State of the Union address at the U.S. Capitol on February 24th. We're telling the major tech companies that they have the obligation to provide for their own power needs. But we'll see. I think this remains to be seen, as I will show you right here. Americans hit with soaring electricity bills as price hikes outpace inflation nationwide. Electricity prices jumped 6.3% from a year ago versus 2.4% headline inflation. So again, why do you think these costs are rising? They're rising because of this ridiculous data center demand, the build out of data centers. These data centers are going to siphon a ridiculous amount of energy out of the system, and it is going to cause these prices to spike. Now, you could sit there and say that these guys are, again, you could sit there and say that these guys are making a pledge, but what does a pledge mean at the end of the day? Is a pledge really forcing them to buy, their own electricity? And what does buying the electricity, like, think about it. They are already, when you look at their numbers, they are already stretching their free cash flow beyond any realm of rational consideration on the amount of money that they're spending just building the data centers. That's just building the data centers. And now the president is asking them to buy their own energy. Like, do you really think that they don't have enough money to build the data centers? Do you really think they've got enough money to buy the electricity too? No, these guys are going to, they want to have, I've said this before, they want to have their cake and they want to eat it too. They want to, they want to build this stuff out. They want to control all the infrastructure, and then they want you and me to pay for it. So we'll see. I love the fact that the president is doing this. I think it's the right thing to do, but the question remains, despite this great photo op at the White House and everything, they get them to sign this pledge. Are they going to honor it? Are they really going to honor it? I don't think they will. I really don't. I just don't think they will at the end of the day. So, all right, now let's get into some Epstein stuff here. So obviously I did a whole, I covered this in the live stream the last couple of weeks, and I said that the Epstein fallout was just starting, and here we are. So we're going to run through a bunch of articles here on this. So how JP Morgan's banker stayed close to Epstein after the bank fired him as a client. Two of the firm's bankers maintained close ties with Epstein as he took on a bigger role running Leon Black's family office. Now, keep that name in mind, Leon Black, because he's going to come in here. The last article I got, we're going to come back to Mr. Black here just a second at the end here. So JP Morgan Chase has said it fired Jeffrey Epstein as a client in 2013. Of course, that was 5 years after his conviction. Remember that, 5 years after his conviction. Newly released documents show how its bankers maintained ties with the convicted sex offender for years as he helped manage Apollo Global Management co-founder Leon Black's fortune. Two JP Morgan managing directors, Justin Nelson and Paul Barrett, used their connections to Epstein to develop a commercial relationship between the bank and Black's family office starting in 2014. Recently released documents show Nelson had been Epstein's banker before the bank kicked Epstein out in 2013, while Barrett had helped find investments for him. The Journal reported in 2023 that Nelson and Barrett had scheduled multiple meetings with Epstein from 2014 to 2017. JP Morgan said at the time that any meeting held with Epstein after 2013 was regarding other JP Morgan bank clients whom Epstein represented. What does it matter? What does that matter? Nelson remains a senior banker at JP Morgan, while Barrett left in 2017 to work directly for Epstein. Wow, how about that? Now this is just too. I think J.P. Morgan has a big Epstein problem. I think they have a big Epstein problem. Whether they can, again, Jamie Dimon, he could try to downplay this all he wants, but then I would point people to this premier scumbag right here. Uh, Former J.P. Morgan and Barclays exec Jess Staley tells court that he slept with Epstein assistant. Okay, so this guy actually admitted in court a year ago that he was doing all kinds of disgusting and horrible things. This scumbag right here was one of the main guys at J.P. Morgan. Now, he did leave to go become, I think, the CEO of Barclays. Former Barclays boss, Jez Staley. Again, I don't even want to read all this stuff or whatever, but this guy was one of the premier scumbags involved in all this. And he was at JP Morgan for the bulk of the time that he was dealing with Epstein, along with these other guys. And this guy, I have no doubt this guy should be in jail. This guy should absolutely 100% be in jail today. But let's continue on here. Let's look at some other things. Epstein files. So longevity guru Peter Attia, if I say that right, he quits NBC News after email fallout. So longevity guru Dr. Peter Attia resigned as a contributor to CBS News amid fallout over his past email correspondence. Then we get to, this was a big one. World Economic Forum CEO quits after Epstein ties are scrutinized. So Björn Brend, who became president of the WEF in 2017, announced his decision in a statement following disclosures from the U.S. Justice Department that showed the Norwegian had 3 business dinners with Epstein. The co-chair said that WEF's Alois Zwiggy will serve as interim president and CEO, and that the forum's board of trustees will oversee the leadership transition. Now, I think this guy stepped down immediately, because I would not be shocked if there's more to come out on this guy. I think that's why he was so quick. This guy, the minute his name came up, he bolted. I think that tells you right there that there's more to come out on that guy. I guarantee that. So the World Economic Forum CEO quits. Let's keep on rolling. We had a lot more here. Ex-UK ambassador to the U.S., Peter Mandelson, released on bail after he was arrested. So it's nice to know that the people in the UK are willing to arrest some of these perpetrators. It would be nice if our DOJ would do that. But the police in London released Peter Mandelson, Britain's former ambassador to the United States, on bail Tuesday after his arrest hours earlier. Mandelson has been under investigation for his relationship with Jeffrey Epstein. Metropolitan Police said Lord Mandelson was arrested on suspicion of misconduct. Yes, indeed. So, and then it keeps on rolling here. It does not stop. Larry Summers, former Treasury Secretary, resigned as Harvard professor as fallout continues. So Larry Summers, the former Treasury Secretary who has been dogged by his past friendship with Jeffrey Epstein, will resign from teaching at Harvard University by the end of the current academic year. Summers previously served as president at Harvard. Summers' announcement comes 3 months after he took a leave from Harvard, where he had been teaching classes, and after he resigned from the board of the artificial intelligence company OpenAI amid controversy over the release of emails between him and Epstein. Now, I am not a fan of Larry Summers. I've never liked Larry Summers. I believe Larry Summers has a lot to answer for his role in the financial crisis back in 06, 07, and 08 when he was the U.S. Treasury Secretary. I think he was a horrible Treasury Secretary, and I don't think he's ever really been held to account for his role and everything that happened. But then you add all of this on top of it. And this guy's toast. So yeah, Larry Summers is done. He's done. And let's continue on here. So Mr. Gates, let's get to Mr. Gates, probably the biggest monster of all. Mr. Gates reportedly apologized, admits to 2 affairs in a candid town hall. Now, we're not going to get into all the salacious activities here, but this guy, right there with Jez Staley, he should be, the 2 of them should be sitting in a jail cell right now. I got some pretty hardcore feelings on that one. Nobel winner Axel quits Columbia University Brain Institute over friendship with predator. So Dr. Richard Axel, a Nobel Prize winning scientist, said he is stepping down as co-director of Columbia University's Zuckerman Mind-Brain Behavior Institute on the heels of his association with Jeffrey Epstein. My past association with Jeffrey Epstein was a serious error in judgment, which I deeply regret. Yes, Dr. Axel, you might say that. Absolutely. Axel won the Nobel Prize in Physiology or Medicine in 2004 with Linda Buck for his discoveries of odorant receptors and the organization of the olfactory system. The prize website notes. So, and then we get into the final article here on this. So the school photography company caught in the Epstein file frenzy. Online sleuths have sparked a boycott of LifeTouch over its ownership by Apollo. Now, remember what I said about Leon Black at the beginning. So the blast radius of the Epstein files has topped C-suite executives, shamed financiers, and led to the arrest of a former British royal. Now, School Picture Day is in the crossfire. So a social media-led boycott has honed in on LifeTouch, the photography company hired by thousands of U.S. schools each year to take portraits of students. Online sleuths poring over government files have drawn a tenuous connection between the 90-year-old company and Leon Black, the former CEO of its private equity owner, Apollo Global Management. The backlash has prompted school districts across the country to cancel their contracts with LifeTouch. But unlike Jeffrey Epstein's cozy messages with some business leaders or smiling photos of billionaires on Epstein's island, there are no exchanges with LifeTouch executives in the Epstein files. Its parent company, Shutterfly, was acquired by Apollo 1 month after Epstein's death in 2019, and it is one of nearly 200 companies in Apollo's vast portfolio, which Black hasn't overseen in 5 years. However, what does LifeTouch do? LifeTouch gets pictures of little kids all across the country in K through 12 schools. What did Epstein do? Yeah, he trafficked kids, okay? Trafficked kids. All right. So this is why, begin to see like, yeah, where there's a little smoke, there might be some there might be some fire, So again, so just recapping this, this is just wild. You've got multiple JP Morgan bankers tied up in this. You've got this longevity guru kicked out by CBS News, World Economic Forum CEO, ex-UK ambassador to the US arrested, led on a file. Larry Summers resigns from Harvard. Bill Gates openly admitting I think Bill Gates is going to go down in flames here. This Nobel Prize winning scientist from Columbia University. It's just this is going to keep. I promise you, this is going to keep going. This is not going to stop here. And you can understand now why they fought so hard to keep all these files and all this information closed for so many years. Because you see the caliber of the people that were involved here. You got U.S. ambassadors, you got former U.S. Treasury Secretary and head at Harvard. You've got Bill Gates. You've got, it's just the list just goes on and on and on. You got Nobel Prize winning scientists. These were not normal everyday people. These were not people just, this is not, Joe Bag of Donuts walking around here. This was like the creme de la creme of society, the wealthy, the elites of academia, of business, of Wall Street. And it's sickening. It really is sickening to see this. But again, as this fallout continues, I will cover it. All right, let's see what else we got here. So a little bit of tariff news here real quick. So Trump considers new national security tariffs after the Supreme Court ruling. So new levies on a half dozen industries would be issued separately from a new global 15% levy. So again, I think that this is part of the administration. They are going to experiment, I think, with some of these other tariff laws. They're gonna find a way to put their tariffs out there. They just are. So we'll keep an eye on that. So U.S. trade representatives say nations are not backing out of tariff deals. The deals were not premised on whether or not the emergency tariff litigation would rise or fall, said U.S. Trade Representative Jamieson Greer. So that while that is true, they may not be backing out yet. But I think the European Union, a couple others, are basically they've kind of put some of these trade negotiations on hold for the moment to kind of see how things play out. So I think we got to look at that, and then FedEx sues Trump administration for full tariff refunds after the Supreme Court ruling on the IEEPA. Shipping giant files lawsuit seeking full refund of duties paid under the president's emergency order last year. So obviously, a ton of companies are lining up, and I'm sure the lawsuits are going to fly, and they are going to try to get their tariffs back. Now, if I was the administration, again, my thought is I wouldn't try to fight them on these lawsuits. I would basically say, hey, yeah, you want the money back? Here you go. I'd hand the money right back to them, and then I'd just hand them another bill. I'd say, here you go. Here's your $5 billion back. And oh, by the way, since you wanted that money back, here's a new bill for $7 billion. Okay, so here you go. And I think that's exactly what the administration is going to do. But we'll see. We'll keep an eye on that. So. And then I was going to get into this, but I'm kind of running a little late here, so I'll save this for maybe next week. So why tariffs aren't shrinking the U.S. trade deficit, because this really requires a little bit more of an in-depth conversation, and I'll like I said, I'll probably save that and come back to that. All right, so just some banking articles real quick. So this was an interesting piece of news this week. So PayPal draws unsolicited takeover proposals. So there was a little bit of curiosity here. So PayPal getting some unsolicited, and then people were kind of wondering, well, who might be some of the companies? And then it turned out that Stripe was one of the companies that apparently now is vying to buy PayPal. Now the question is, would they keep Venmo, or would they spin Venmo out? I mean, that's one of the kind of interesting questions here. But I think that, again, maybe surprising, maybe not surprising, I do think that PayPal could get bought here. And whether it's Stripe or whether it's another company, I think that is a good possibility. But we're going to keep an eye on that one. Okay. Education Department confirms ongoing talks to privatize over $1 trillion in student loans. So again, we've looked at this before. So the Department of Education is still considering privatizing its almost $1.7 trillion student loan portfolio. Since the start of President Donald Trump's second term, his administration has sought to sell borrowers' federal student loan debt to a private lender and to close the Department of Education to help lower federal spending. So yes, I think this will probably heat up in the next couple of months. We'll see what happens with this one. We'll keep an eye on that. Again, this was another one I wanted to get into, but I didn't really have enough time here tonight. But K through 12 reading math scores lagging behind pre-COVID-19 pandemic levels, according to a study. State math and reading assessments for 2026 have been updated with questions that align more closely with what students are learning now. So yeah, so I'll come back to that one next week. And then last couple of things. So Payoneer, I love the name Payoneer. Payoneer applies for OCC National Trust Bank Charter. The cross-border payment platform joins the influx of fintechs seeking a banking license to issue the custody stablecoin. So we'll see what happens with that. Crypto.com, they actually get the OCC's conditional nod for a charter. So the green light, which came roughly 4 months after Crypto.com applied, follows conditional approvers for trust charters at Circle, Ripple, Paxos, and most recently Bridge. So Crypto.com getting in on the action now. Now, how the OCC is handling its charter application workload. So the agency is handling a swell of new bank applications by pulling talent from the supervision side into 1 or 2 year rotations, and the OCC's chartering arm, controller Jonathan Gould, said. So the OCC is working hard trying to deal with all of these brand new charter applications. This was kind of an interesting story. Centerview ex-analyst settles suit over sleep hours for junior bankers. So Catherine Schibber requested a regular hard stop at midnight to sleep and manage a mood disorder. The bank granted the accommodation, but later fired her. Terms of the settlement were not disclosed, but she did win. Catherine basically did win her lawsuit. But this article brings into a lot of questions around like junior bankers, how much they're asked to work, 7 days a week, 100 some plus hours a week. It's brutal. It's brutal. But I will say this though. I mean, you chose that profession, right? You chose to be in that part of the business. That was your choice, and so kind of hard to complain about it if you chose that's what you wanted to do and you kind of knew what you were getting into, because that's not new. That's been going on like that for a long time. So so it's kind of shit. But we'll talk about that more next time around. TD aims to retain its branch essence amid a brand refresh. So, as the bank leans into digital banking, it wants to meet evolving customer expectations, deeper relationships, and retain customers. So, TD Bank is basically looking to close a bunch of its branches, give a little bit of a refresh to some of the branch look, and add some new tech and things like that, and go from there. So, we'll see how that pans out for them at the end of the day. So, okay. Wow, what a night! A lot. Did I tell you? Did I tell you this was going to be action packed? Did I tell you that there was going to be a lot to cover tonight? Absolutely. It's like a lot of stuff going on, right? That is crazy. All right, well, let me go into wrap up mode here real quick so I could get through this, and then we're going to do our story of the week and our quote of the week real quick. So, reviews on Apple Podcasts and Spotify. So, if you are on Apple Podcasts, if you're on Spotify, if you're listening on those platforms, please leave a review. That would really, really help the podcast or really help me out. So please leave a review on those platforms if you can. Make sure to visit the website, www.thebankernextdoor.com. Have a lot of great stuff up there on the website to check out. Make sure to subscribe on YouTube if you want to get the major latest breaking news, episode information, anything going on with what we're covering here on the live stream every week. Make sure to subscribe on YouTube so you can get the posts that I put up on there. Again, at least feedback that I've got, a lot of people like that. So you could send comments, questions, or topic recommendations to info@thebankernextdoor.com. That's how you reach me. So info@thebankernextdoor.com. Also, make sure to follow me on social media. I am up on Getter, X, and True Social, although I will tell you I spend the most time on X. Let's see here. And then finally, remember that BND is on YouTube, Rumble, and all major podcast platforms. I put out new episodes every week, Monday through Friday at 12 noon. And then BND Strategy Room live stream is Saturday nights at 8 p.m. here on YouTube, expanding to other platforms soon. I know I've been saying that for months, but it will happen here, hopefully sooner rather than later. So. All right, that being said, let's get to our story of the week. So I thought this was interesting. So on February 25th, 1862, President Abraham Lincoln signed the Legal Tender Act, putting the U.S. government in the business of printing paper money. The act also authorized the Treasury to sell 6% bonds callable in 5 years, maturing in 20, which are nicknamed 520s. Philadelphia broker Jay Cook then pursued what he called the democratic distribution of investments, slicing the 520s into denominations as small as $50, advertising them in newspapers and hiring an army of traveling agents to sell them. He raised $361 million, introducing thousands of Americans to investing for the first time. Now, I really want to cover Jay Cook because he is a fascinating character in kind of the very early, if you want to say Wall Street, but basically he was in Philadelphia when Philadelphia was the center of the financial world for the United States. And obviously over the next 10 to 15 years, as you got into the 1870s, that power really moved to the first time to Wall Street. It was in the 1870s that Wall Street really rose to prominence, specifically after the Panic of 1873. Was when you really saw that movement happen. But Jay Cook really was an interesting character in the financial world, had a really interesting life, and I will definitely have to cover him in more detail one of these days. That is for sure. So okay. Now, last but certainly not least, our quote of the week. So, given what happened over the night with Iran, the U.S. doing airstrikes on Iran, I was really looking for a kind of a military quote, if you will. So I found this from Admiral William Halsey. So there are no great men. There are only great challenges which ordinary men like you and me are forced by circumstance to meet. And that was by Admiral William Halsey. And William Halsey was amazing, absolute legend. William Halsey had a lot of famous quotes. I mean, if I could probably find, 10, 15, 20 famous quotes from Admiral Halsey. Legendary, absolute legendary guy. So, but with that being said, hey, I thank you so much with everybody hanging out with me on a Saturday night. I hope everybody has a great weekend out there. I will be back. Obviously, new episodes coming out this week, Monday through Friday. I will be back next Saturday night to see everybody once again back here in the strategy room. Have a great weekend. Have a great night out there. And I will see everybody out there again real soon. Thanks a lot.